31 million deferred until 1st of April 2026. This is what you refer to as the deferred what? Consideration. And then you're told no accounting entries have been made in respect of the deferred cash consideration. 𝐎𝐿𝐶 Limited has a cost of capital of 10%. And then you're told on 1st of October 2024, 𝐿𝐶 Limited together with another entity entered into a joint arrangement to jointly control 𝐶𝐶 Limited, a public limited entity, public limited entity. Effectively, 𝐿𝐶 Limited purchased 50% of the equity shares of 𝐶𝐶 Limited for an immediate cash payment of 1,500 million. The following financial statements relate to the group of companies. So we are given the statement of profit or loss, basically for the three companies, 𝐿𝐶, Paper, and 𝐶𝐶. We have the statement of financial position for the three companies, that is 𝐿𝐶, Paper, and 𝐶𝐶. And then we have some additional information. This was actually one of the simplest questions, which has been tested in advanced level for group account. So we're given additional information. You can see actually the additional information, we're just given like 4 additional information. Then what are we required to do? Part A, we're required to prepare the consolidated statement of profit or loss for the year which ended 31st of March 2025, the consolidated statement of financial position as at the same date. Now, before we do that, automatically this is a question for group account. The first thing we need to do is we come up with a group structure. We know the relationship, the nature of investment by the parent company in the other companies. We go through the additional information as we do or maybe we do any working which is necessary. So we go straight to the workings, and basically the first working here will basically be to come up with a group structure. To come up with a group structure, that's the first thing you always need to have in any question for group accounts. The group structure. So where do we have the information about the group structure? This information, we have it within paragraph 1. Let's go back to paragraph 1 of our question, and we are told the company which is called 𝐿𝐶 Limited, a public limited entity, acquired 80% equity shareholding in a company which is called Paper, a public limited company on 1st April 2024. So the company which is called 𝐿𝐶 Limited, this company acquired 80% equity shareholding in a company which is called Paper Limited, on which date? 1st of April 2024. 1st of April 2024. It basically means that 𝐿𝐶 is the parent and then Paper is the subsidiary. You can see also we given the date of acquisition. Then from there, we go to the paragraph number 3. Let's go to paragraph 3. We skip paragraph 2. In paragraph number 3, we are told on 1st of October 2024, 𝐿𝐶 Limited, our parent company, with another entity entered into a joint arrangement to jointly control 𝐶𝐶 Limited, a public limited entity. Effectively, 𝐿𝐶 Limited purchased 50% of the equity shares of what? Of 𝐶𝐶 for an immediate cash payment of 15. So this company here, we are told acquired 50% shareholding in a company which is called 𝐶𝐶 Limited. 𝐶𝐶 Limited on which date? 1st of October 2024. 1st of October 2024. So it basically means that from this group structure, this will be our parent company, this will be our subsidiary, and basically this one will be a joint venture. That one would be a joint what? A joint venture. So that is the first thing you always need to have, because this is basically what will guide you in terms of how to prepare the group account. So if we go to the requirements, therefore, we are required to prepare the consolidated statement of profit or loss, consolidated statement of financial position. So in preparing those consolidated financial statements, we will add similar items of assets and liabilities, those of the parent, those of the subsidiary. That does not apply to the joint venture. For the joint venture, in the consolidated statement of profit or loss, we will compute the parent company share of profit after tax, another comprehensive income, and also we compute something called the investment in what? In joint venture, or the investment in joint arrangement. This one, we can also refer to it as a joint arrangement, because the parent company have a joint arrangement with another company to control this, to jointly control that one. So I think we have that. Then we will be able to come back to that paragraph 2, because we have the aspect of deferred consideration, but we will only come back there when computing the goodwill. So that deferred consideration, remember we said we have to discount it to its present value using the parent company cost of capital. That's why you can see you're given the cost of capital of 𝐓𝐿 Limited. That is for the purpose of getting the present value of that. So I want us to go to the additional information now. Let's go to note number 1. And in note number 1, what are we told? We are told at the date of acquisition. At the date of acquisition, the fair value of Paper Limited, remember Paper now is the subsidiary. Paper Limited net asset approximated their carrying amount with an exception of some office equipment whose carrying amount was 560 million below the fair value. And then you're told at this date, the office equipment had a remaining economic useful life of 8 years. And then you're told depreciation on office equipment is an administrative cost. And then you're told no fair value adjustment were necessary in the acquisition of 𝐶𝑠A. What does that mean? It means that on the date this company was acquired, that is the subsidiary company revalued the assets. Revalued the asset. And if you can be able to recall, we refer to that as the fair value adjustment or the fair value exercise. And actually, we said once the subsidiary company revalues the asset, the subsidiary company does not account for that revaluation. As a result of that, when preparing the group account, we talked about 2 key consolidation adjustments we make. The first one is called the revaluation adjustment, which is an adjustment relating to the revaluation gain, and the other one is depreciation adjustments, whereby you have to compute depreciation and the charge. So therefore, we need to do some working as far as that is concerned. Note 1 is concerned, which you are saying is a fair value adjustment, or basically the fair value exercise. Let's just refer to it as the fair value adjustment, and this is by Paper Limited. By Paper Limited. So we need to make 2 adjustments as far as this is concerned. The first one is called the revaluation adjustment. And basically, this is the adjustment in relation to the revaluation gain or loss. But remember, you said in most of the questions for group account, you'll come across a revaluation gain. So that's why we are told in the first paragraph, in the first sentence of note 1, we are told at the date of acquisition, the fair value of Paper Limited net asset approximated the carrying amount with an exception of an item of office equipment whose carrying amount was 560 million below. So this one was below or was less than fair value with 560 million. In other terms here, we can say the fair value, we start with the fair value, then we change this inequality sign. Remember, this was less than. So we change this now to greater than. If we start with this, so this one will be greater than carrying amount with an amount of what? 560. So if the fair value of an asset is more than its carrying amount, automatically that is a revaluation gain. So the fair value of this item of office equipment was more than carrying amount. Remember, carrying amount, this one can also be known as the net book value with an amount of 560 million. So because this revaluation, okay, this 561, we are saying this is a revaluation gain. This is a revaluation gain by Paper. Did the Paper Limited accounted for this revaluation gain? No. So therefore, in preparing the consolidated financial statement, this one will be added to the group PP. And number 2, we say that this one is a pre-acquisition revaluation reserve. Being a pre-acquisition revaluation reserve, we use that in the computation of goodwill, because we say in computing the goodwill on acquisition of this, we need to have we need to compute its fair value. We need to compute the fair value of its net asset on the date of acquisition. How do we compute that? We take the ordinary share capital of the subsidiary plus pre-acquisition reserves. This will be one of the pre-acquisition reserve. Next, we need to compute something called the depreciation other charge. Depreciation other charge. And equally this depreciation other charge will be by Paper, is by Paper Limited. So you need to recall the formula. There is a formula which I gave you here. That is basically what you need to remember. We said we take the revaluation gain, divided that with the remaining useful life of the asset, And then we multiply this with what? With the proportion of time. The proportion of time is basically the time we have, or basically the number of years, the number of months we have from the date of acquisition, the date of DOA, to the date of consolidation. Remember, the date of acquisition is the date the subsidiary was acquired. The subsidiary was acquired on which date? There, 1st of April 2024. The date of consolidation, this one, DOC, this is the date we are required to prepare the group accounts. And if you go to the requirement, you'll be able to see when are we required to prepare the group accounts as per the requirement. The year which ended 31st of March 2025. So that is the date of consolidation. And actually this year, because the year of the group is ending at 31st of March, it starts on 1st of April. So this year started on 1st of April 2024. So therefore you can see our subsidiary here was acquired exactly at the start. Was acquired exactly at the start of what? Of the year. So therefore, the proportion of time we have here will be 1 year. Will be one what year? We're interested with the depreciation other charge for 1 year. We will take the revaluation gain, which we have here, 560 million. We are applying this formula. We divide that with the remaining useful price. And I hope you can see that within note 1. Can you see the remaining useful price? How many years? In note 1, remaining useful price. In note 1, how many years? Who can see that? Who can see that? Who can see that? 8 years. The remaining useful price of that asset. Can you see that? Should be 8 what? 8 years. 8 years. So we divide that with 8. And then the proportion of time here we are saying is 1 what? Is 1 year. If, for example, in our case, we had 6 months here. We had 6 months. So then the proportion of time here is always 6 over 12. If we had, for example, 2 years, we're interested in the depreciation under charge for 2 years. Our proportion of time should be 2. Should be what? 2. But in our case, we're interested with depreciation under charge for how many years? For 1 year. For 1 year. For 1 year. So this will give us 70 million. Now, this 70 million, which items will be adjusted here? One, this one will be deducted from the group PPE. When preparing our consolidated statement of financial position, we left that from the PPE. Number 2, we will also deduct this from the retained earnings of which company? Of paper. Retained earnings of paper. And number 3, in preparation of the consolidated income statement, because we are required to prepare that, the consolidated statement of profit or loss, this one will be adjusted where we have said any depreciation under charge should be added to the cost of sales unless otherwise. If you check on the information which are given in note number 1, we are told that depreciation of the office equipment is an administrative expense. Are we going to add this to the cost of sales? No. No. So in this case, we will add this depreciation under charge to what? To the administrative expenses. To the administrative what? Expenses. But if the question was cited, that one should be added to the cost of sales. So we are done with that. This is something which you have to understand, because in all questions for group account, you will come across this particular concept that the subsidiary company revalued the asset but never accounted for that. Which adjustments are required? 2, the revaluation gain and the depreciation under charge. Let's move to point number 2, where we are told 𝐎𝐿 Limited, which is basically the parent, measures the non-controlling interest in subsidiaries at the fair value. This is something I explained, that if you come across that information, that it is a policy of the group, it is a policy of the parent company to measure NCI at fair value, that information is basically to help you in computation of goodwill. And who can tell us, based on that information, which method are we going to use in the computation of goodwill? The goodwill on acquisition of this subsidiary. Which method are we going to use? Are we going to use the partial goodwill method? Are we going to use the full goodwill method? Which method are we going to use based on that information which we have there? Based on that information, which method are we going to use? Maureen, Georgina, which method? Benson, Gilbert, which method are we going to use? Automatically, we are going to use the full goodwill method. The full goodwill what? Method. That's why still in point number 2, we are told the fair value of the non-controlling interest of paper limited at the date of acquisition was 860. That is for the purpose of computing what? The goodwill. That is the NCI fair value. So no working which is required there. Let's move to point number 3. And you're told during the year which ended 31st of March 2023, Paper Limited sold goods to Rock Limited for shillings 500 million at a markup on cost of 25%. First of all, this goods which was sold by Paper Limited to Rock, this one we refer to that as amount of intragroup trading or intragroup sales. Intragroup trading. And basically we are told the goods which were sold by Paper to Rock, they had a value of 500 million. So basically we have said that these sales between the parent and the subsidiaries are fixed sales. So therefore this one will be deducted from the group revenue. This one will be deducted from the group revenue. And number 2, we will also deduct this from the group cost of sales. Group revenue and also group cost of what? Of sales. So then in the same point, we are told half of these goods were still held by Rock Limited as at the end of the year, and the balance payable was still outstanding, and the balance payable was still what? Outstanding. Now, in that case, we have 2 adjustments here. The first adjustment is adjustment for unreleased profit and also adjustment for amount of intercompany debt. I want us, first of all, we deal with we compute the amount of unreleased profit, So unrealized profit on inventory. Remember, unrealized profit, we said arises whereby we have sales between the parent and subsidiary, and some of the goods sold to the buying company will not have been sold to third parties. In that point, we are told that this company, which is called Paper, our subsidiary, sold some goods now to Rock, but basically some of the goods remained in the inventory of Rock. They were not yet sold to third parties. We need to compute the unreleased profit, and this unreleased profit is always by the selling company. The selling company is this one. So this is unreleased profit by Paper. So how do we compute this unreleased profit? We take the unsold goods times the gross profit margin. Times the gross profit what? Margin. That is the formula you need to remember. The formula for computing what? For computing the amount of unrealized what? Unrealized profit. So let's proceed and we compute the unrealized profit basically by applying this formula here. We will take the unsold goods. And in that case, we are told the goods not yet sold at the end of the year were half. Half of these goods were still held in the inventory of Rock. The unsold goods will be half of the goods which were sold by Paper to Rock, which is basically 500 million. These are the unsold goods. The unsold goods, we multiply that with the gross profit margin. The gross profit margin, is it given? No. What we are given in our question, we are given the gross profit markup. Gross profit markup is 25%, which is basically the same with a quarter. Which is the same with what? A quarter. So having this, can we be able to determine the gross profit margin? Who can tell us which will be our gross profit margin here? Our gross profit margin, I'm told by Gilbert, will be 20%. As a fraction, it will be equal to what? As a fraction, automatically that one would be a quarter. And then to the denominator, we add the numerator. It will be 1/5. So this one will be the margin, will be 1/5. So how much will be our unreleased profit here? So it will be half to 50, and basically that will be 50 million. So this unreleased profit number 1, this will be deducted from the group inventory. In preparing our consolidated balance sheet, we let's start from the group revenue. Number 2, this one will also be deducted from the retained earnings of the selling company. The selling company is Paper. That one will be deducted from the retained earnings of Paper. And then In preparation of the consolidated statement of profit or loss, this one we have said should be added to the group cost of sales. To the group cost of sales. Those are the three adjustments which will be made as far as that and his profit is concerned. So we are done with point number 3. But even before you move to point number 4, in the last part of that, that point number 3, we are told and the balance payable was still outstanding. The balance payable was still outstanding. What is that? Balance payable was still outstanding. What is that? Who can tell us? Balance payable was still outstanding. Balance payable was still outstanding. Basically, that is the amount of intercompany debt. Now, if this company sells some goods to this, so it is obvious that this company, the parent company, should pay who? Should pay the subsidiary. But in this case, we are told the balance payable, was still what? Was still outstanding. So how much will be the balance which was payable? The balance payable. The balance payable should be what? The balance payable will be what? The balance payable here will be 500,000, 500 million, that is, because the amount of money which 𝐎𝐿𝐶 Limited was supposed to pay paper was 500 million. So this amount is the one which amount to, or is the amount of intercompany debt. Amount of intercompany what? Debt. So in this case, it will be 500 million. So this one will be deducted from the group receivables, and also it will be deducted from the group what? Payables. Group receivables and group what? Payables. We move to point number 4, and we are told impairment review performed on 31st of March 2024, that is at the end of the year, basically revealed that both goodwill on acquisition and on paper limited and the interest in sisters were unimpaired. So the goodwill on acquisition of this, the investment in the joint venture were not yet impaired. So no working which is required. Number 5, incomes and expenses of the group of the companies are deemed to have accrued evenly throughout the year. So that information is always given such that if there is something you need to apportion on time basis or something you need to apportion, you apportion it on time basis. You apportion it on time what? Basis. And I think having said, there is something we need to compute before we proceed to prepare what is required. I want us to compute the goodwill on acquisition because there is something we will compute there. Let's first of all, we compute the goodwill on acquisition of this company here. Remember, you said we only compute the goodwill on acquisition of the subsidiary and we recognize that as an asset within the consolidated statement of financial position. The goodwill on acquisition of joint venture, the goodwill on acquisition of the associate is not computed and recognized as an asset within what? The consolidated statement of financial position. So let's compute the goodwill. The goodwill on acquisition of this company that is paper, paper limited, and as per the information we have in note number 2, we are using the full goodwill method. We are using the full goodwill method, So here we need to have 2 columns. And our figures are in million of shillings. I hope you can be able to remember how we compute the goodwill using the full goodwill method. We start with the purchase consideration, which was paid by the parent company. The purchase consideration paid by the parent company. The purchase consideration paid by the parent company, this one is given within paragraph 2. Paragraph 1 and 2. Let's go back to paragraph 1 and 2 of our question. So first of all, we go to paragraph 1. Actually, paragraph 2, not paragraph 1. Paragraph 2. We are told the acquisition consideration. This is the acquisition of the subsidiary. The acquisition consideration consisted of an immediate cash payment of 2,400 million. So the parent company paid the purchase consideration. The purchase consideration paid by the parent company was in two forms: the cash consideration, and I hope you can be able to recall, we say that this one do not have any special treatment. That amount we are going to use it as 2,400 million. So an immediate cash payment of 24. And this one, if you go to the balance sheet or the statement of financial position of the parent, under the non-current asset, you should be able to see that amount. So the moment the parent company has paid some cash consideration in acquiring a subsidiary, that is accounted for as an investment in the statement of financial position of the parent. I hope you can see that, 24. And then we also have a deferred consideration. The deferred consideration. So the deferred consideration still in that point number, paragraph 2, we are told an immediate cash payment of 24 and on 1st April 2024, and a further consideration of that 1331 million deferred until 1st of April 2026. No accounting entries have been made in respect of the deferred cash consideration, and 𝐓𝐿 Limited cost of capital is 10%. These are deferred considerations which we said should be discounted to its present value using the parent company cost of capital. So we are going to discount that to the present value. So we will take 1331 and basically we discount this to the present value by multiplying that with the present value interest factor at the rate of 10%. And basically for how many years? How many years do we have from the date of acquisition? 1st of April 2024. This is the date of acquisition. That consideration will be paid on 1st of April 2026. How many years do we have here? How many years do we have there? Yes, we have 2. We have the first year which will end first, or basically 1st April 2025, 1, 2. So for 2 years. So this one will be computed like this. We take 1. Remember the formula here: 1.1 raised to power negative 2. Yes, basically that's how we discount this. 1.1 raised to power negative 2, raised to power negative 2, raised to power negative 2. That's basically how we are going to discount that. Times 1331. And basically that one is coming to 1100. Is that what you're getting? 1100? 1100. 1100. 1100. Is that what you're getting? Diana, is that what you're getting? Georgina, is that what you're getting? Is that what you're getting? Yes. Okay. So then this is basically the purchase consideration paid by the parent. And then now to this, what do we need to do? We need to add the NCI at fair value. Remember, you're using the full goodwill method. The NCI at fair value, this one is given in note number 2. Is given in note 2. So the NCI at fair value is 860. 860. So we need to add those 3 values so that then we proceed and we less the net assets, which one? Acquired. And basically, I'm told that this one will give us 4360. 4360. Okay. So then to this, what do we need to do? To this, we need to proceed and we less the fair value of net assets which were acquired. So remember, you say that this is one of the items which the examiner will not have given you, and this whereby majority of the students have a challenge. How do we compute this? We say to compute this, we take the ordinary share capital of the subsidiary plus pre-acquisition reserves. Plus pre-acquisition reserves. So what we do, we have to go to the balance sheet of the subsidiary, specifically at the equity. Can we go to the balance sheet of the subsidiary? Subsidiary is paper, specifically at the equity. At the equity, we start by taking its ordinary share capital. Its ordinary share capital was, or is basically 2,000. Below that, what do we have? We have share premium. In this case, if you're given a share premium in the balance sheet of the subsidiary, and the question is silent, the question is what? Silent. We always treat that as a pre-acquisition. We always treat it as what? As a pre-acquisition. And then from there, we have the retained earnings. The retained earnings. But basically what we know is that retained earnings which we have there, that is the retained earnings at the end of the year. So what we are interested with here is the retained earnings on the date of acquisition, because this is a reserve. This is a reserve. We're interested with the retained earnings on the date of acquisition. And basically what we know, I've said that the retained earnings which are given there of 1,800, this is the retained earnings at the end of the year, 31st of March 2025. So we are interested with the retained earnings of paper on the date of acquisition here, 1st of April 2024. How do we get that? Very simple. Because one, we know the retained earnings of this company for the current year. In other terms, what is the profit after tax of paper? So the retained or the profit after tax of this company during the current year. So you get that from the income statement. Can we go to the income statement of paper? The income statement of paper, you tell me how much was its profit for the current year. How much is the profit after tax for the current year for paper? Can you see that amount? It is 520. It is 520. So how do we arrive at this value here, the retained earnings at the end? To arrive at this, we take the retained earnings at the start, which we don't have. We add this, we get this. Sasa, we take this plus this, we get this. What we are interested with is the retained earnings of this date. So can we be able to get this? Take into account to get this, we take this plus this, we get this. It's very simple. So to get this one, we will take this minus this, we get that. So therefore, the retained earnings at the start will be 1,800 minus 520. And this will give us 12 what? That will give us 1280. 1280. So 1280 is basically the retained earnings on the date of acquisition. And therefore, if you check there, we don't have any other reserve. But in all this particular question for group account, there is something you must always remember to check. Did the subsidiary company revalue the asset on the date of acquisition? If yes, was there revaluation gain? Remember here, paper limited revalued the asset. There was a revaluation gain of 560, which we said is a pre-acquisition revaluation reserve. So we have a pre-acquisition revaluation reserve of what? Of 560. Yes, we don't have anything else. Let's get this total. Let's get this total. This will give us a total of what? This will give us a total of 40. So because you're using the full goodwill method, we take 100% of that. When using the full goodwill method, take 100% of this. We are interested with the net asset acquired by the parent and the NCI. Parent and the NCI. So this will give us 40. So we less it from the figure we have up there, and basically we get the goodwill. We get the goodwill. So our goodwill will be what? Will be 320. Now, also you have to check, was this goodwill impaired? In our case, we are told as per the information we have in note number 4, the goodwill was not impaired. So I think having this now, I want us now we prepare what we are required. And because we have now the workings, all the workings, basically to prepare what is required should not take us a lot of time. So we go straight to part A, the consolidated statement of profit or loss. Let me just have that here. The consolidated statement of a profit or loss, which is for the year, which ended 31st of March 2025. 31st of March 2025. Yes, so here we just need to have a single column, and basically we indicate that our figures are in million of shillings. So how do we prepare this? As per our group structure, we are basically combining the revenue and expenses of the parent, those of the subsidiary. We combine the revenue and expenses of the two companies. It is also important to note that this company, taking into account it was acquired exactly the start of the year, we will take the revenue and expenses of paper for the whole year. For the whole year, we combine with that of the parent. In our case, remember, we don't consolidate a joint venture. Instead, what we will compute is the parent company share of the profit after tax, and basically we recognize it what? Here. So let's do that now. So how to prepare this, we go to the statement of profit or loss for individual companies, which is basically given below paragraph 2. and we use the format which are given there. So we will start with the revenue. We take that of the parent, 520, plus that of the subsidiary, which is paper, 51.80. So remember, we are not consolidating their joint venture. So and then to this, what do we need to do? We need to less any sales between the parent and the subsidiary. And I hope you can remember you have this intra-group trading of 500 million. We less it here. No any other adjustment. No any other adjustment. We get the final value. We try to hurry up so that we finish. Although I can see we have time. We have time. So once you get the answer, type it in the chat box. I'll be able to see it. So I'm told that will give us 13,200. 13,200. Someone else to confirm. Is it 13,200? Is it 13,200? Is it 13,200? Yes. So then below that, we take the cost of sales. We do the same. 5510 plus 3440. So to this, we have a number of adjustments to be made. One, we less this amount of intra-group trading, 500. So we also have this depreciation. Okay, this one will not be adjusted to the cost of sales, but rather to the administrative. We have this and this profit of 50 to be added there. And I don't think we have any other adjustment. So we get the final value there. The final value. Final value, I'm given 85. I'm given 85. Okay. So we move and basically we compute the gross profit. So the gross profit here will be how much? How much will be our gross profit? The gross profit will be 47. So then to that we proceed and basically we add the distribution. I think before we add the distribution, we can do this. We need to compute the group share. The group share of Sisters Limited profit after tax. Remember, this is basically a joint venture. That's what we include here as far as the joint venture is concerned. So what we need to do, can we go to the income statement, the statement of profit or loss of Sisters, and you give me its profit for the year or the profit after tax. The profit after tax for Sisters is how much? Is it 640 million? Yes, 640. Now, then we need to determine when was our joint venture acquired. You can see the date when it was acquired, this date here. 1st of October 2024. This is within the current year. The current year is added, the current year added on 31st of March 2025. How many months do we have here? Are they 6? So we have October, November, December, January, February, March. 1, 2, 3, 4, 5, 6. So in this case, we have how many months? Yeah, are they 6? Are they 6 months? Do we have 6 months? I've said 1st of October 2024. So our joint venture was acquired 6 months to the end of the year. So the parent company will only be entitled to share profit from the date it acquired that joint venture. It will only be entitled to share profit for how many months? 6. That's why we have to compute profit of 6 months, and then we multiply that with the parent company shareholding in Sisters, which is 50%. That gives us now the group share of Sisters Limited profit after tax. You think this one should be 160. This one should be 160. And then from there, let's proceed with the expenses. The first expense we have there is the distribution cost. And I hope you can be able to recall that if you come across these always a free mark. No single question for group accounts will come across whereby the distribution cost is to be adjusted. This is always a free mark. We take 830, that of the parent, plus that of the subsidiary. No adjustment. We get the total, which will be 1,300. Which will be 1,300. Are you getting that here? Yes. So then below that, we have the administrative. expenses. Administrative expenses, we check that of the parent, 860, plus that of the subsidiary, 520. And then to this one, we have to add this depreciation other charge of 70 over 70. Also, in case our goodwill was impaired, in case this goodwill was impaired, any impairment loss for the current year, we also include it within administrative expenses, but we don't have any impairment loss. We get the final figure, which will be what? Which I'm told is 14 what? 1450. 1450. Is it 1450? Yes. So then below that, we don't have any other expense. Okay, there is something we will include here. That one, you have to be very, very keen to remember that. Because I hope you can be able to remember, we have this deferred consideration. You see this deferred consideration, basically this represents what the parent company will have to pay at the end of the second year. So therefore, once we have discounted this deferred consideration to its present value, we have to amortize it. In the process of amortizing a liability, there is something which arises, which is known as interest. If you're amortizing a loan, if you're amortizing even, for example, financial liability, there is something which is known as what? Interest. So that interest is basically recognized here as part of the finance cost. So the finance cost will basically be the interest on this deferred consideration. How do we compute that interest on the deferred consideration? On the deferred consideration, we take this amount which you computed here, the present value of the deferred consideration. And for us to be able to compute the amount to be recognized as an interest during the current year, we multiply this with the rate which you have used to discount, which is 10%. 10%. So this will give us 110. Now this 110 is the interest on deferred consideration. Interest on deferred what? Consideration. And then this interest basically should increase the value for this. So what I'm trying to avoid here is basically to prepare a amortization schedule, but I think I can do that very fast so that you understand. Amortization schedule. We are saying we should amortize this. You see, this is the deferred consideration at the start. This is like our own amortization schedule. You have a column for years, the liability at the start, the interest, the cash paid, and the liability at the end. No need of doing that because we know what we want to do. We want to compute the interest, which will be 10%. And then, is there any cash paid during the current year? No, no cash paid. So therefore, to compute the liability at the end of the first year, we take this plus this. Can you add for me that? So that you understand what we amortize this. So that will give us 1210. So in fact, when preparing our balance sheet, this is the value of our deferred consideration. The deferred consideration is a non-current liability, and that is its value at the end of the year. Then that would be the opening balance in the next year. And then we compute the interest, which is 10% of this. Will it come to 121? Is that what you're getting? Yes. Now we know the deferred consideration, this one, will be paid at the end of the second year. So at the end of the second year, the company will pay 1331. And once you do that, then you should get 0 there. You should be able to get 0. Will you get 0? Yes. Are you getting 0? Yes. So this is how we amortize that word. That. So basically, in relation to this deferred consideration, 2 items. One, this interest is part of the finance cost here, which is 10% of 1100. And then when preparing our consolidated statement of financial position, this one will be recognized as a non-current liability. Sasa? Yes. So having that, then we can proceed and we compute the profit before tax. Give me the profit before tax now. The profit before tax down here. How much would be a profit before tax? This plus this minus the 3 expenses there. I'm told this one will be 2,000. I'm told that one will be 2,000. Will be 2,000. Then we list the other item, which is also always a free mark. Income tax expense. Income tax expense, also this one, is always a free mark. A free mark. So no question for group account whereby income tax will be having adjustment. You take that of the parent and that of the subsidiary. And this will give us what? This will give us 670. 670. And basically we get what? We get profit for the year. Profit for the year, which will be 680. Which will give us which will give us what? 1320. Yes. So basically in our case we are done, and that what was required. The marks allocated there were 10. So this basically what was to give you what? 10 marks. You can see in that question, it basically means that for any correct item which you had here, basically it should be 5 marks, because these 6 cannot be 10. Yes. So having that, let's move to part B. The consolidated statement of financial position. Consolidated statement of financial position is at 31st of March 2025. Okay, so we prepare this one. We just need to have a single column here. And what is basically important for you to remember is that here, or this one is basically prepared by just combining similar items of assets and liabilities, those of the parent and those of the subsidiary only. As far as the associate is concerned, CSAS, we will include something called the investment in associate. So let's prepare this one. We start with the non-current assets. So for the non-current asset, we will start with the PPE, the property, plant, and equipment. So, and basically we take that of the parent 4260 plus 3660. And then you have to recall, we have an adjustment to be made to the PPE in relation to this working. So we said this 560 will be added to the group PPE, and then this depreciation other charge of 70 will be deducted from the PPE. Two adjustments here. Two adjustments, we add the revaluation gain of 560, we less the depreciation other charge of 70. We get the final value there. The final value will be what? What will be the final value? The final value, I'm told by Gilbert, will be 8380. 8380. That is the same figure I'm getting from Diana. So then from there, below that, we have investment in paper, investment in CSAS. Remember, these are the purchase considerations which were paid by the parent company in acquiring shares of CSAS and paper. Do you include that here? No. In relation to the subsidiary, which is paper, what we include here is the goodwill. We include the goodwill on acquisition of the subsidiary, which is paper limited. And basically that's what we computed here, 320. 320. In relation to CSAS, which is the joint venture, we compute something called the investment. The investment in joint venture, or basically joint arrangement. I just refer to it as the joint what? The joint arrangement. And basically we recognize that here is an item of what? As an item of non-current asset. I want us to have the working here, because I remember I've given you the format for computing this. How do we compute the investment in associate or joint venture? I said one, you take the purchase consideration which was paid, or the cost of investment. That is basically what we have within the statement of financial, or within the statement of financial position of the parent and the non-current asset. How much purchase consideration was paid by the parent company in acquiring the shares of the joint venture? That is 15. That is 15. And then to this we have said we add what? To this we have said we add the group share of the joint venture post-acquisition retained earnings. And basically take into account our joint venture was acquired during the current year. CSAS was acquired during the current year. The amount which we include here, which we have included here, that is now the same with the group share of the post-acquisition retained earnings of the associate. That is basically what we will add here. 160, this one. And then to this we less any impairment loss. And I hope you can be able to recall in note number 4, we were told that in note number 4, you are told the goodwill on acquisition, the investment in associate had not impaired. They were unimpaired. So we don't have any impairment loss. And that will give us what? 1660. That will give us 1660. So that basically what we include there. Then from there we proceed and basically we record the current assets. So for the current asset, we are given the total. We will take that is 720. That is of the parent plus that of the subsidiary, 2270. And then in this case, you have to recall that inventory, receivables, cash, and bank balance are part of this. Any adjustment affecting this inventory and receivables should be made here. And I think you can be able to recall here, we have this and this profit, which we said should be deducted from the group inventory. Inventory is part of this. So we less and there is profit of 50. And also we have the amount of intercompany debt, this one, of 500. We also less it here. I don't think we have any other adjustment. So let's get the final figure. We get the final figure. I don't think we have any other adjustments. So what is the final figure here? I'm given 50, 440, 5440, 5440. Yes. So then what will be our total? What will be our total assets? What will be our total assets? You add all this, you give me the total assets. And because of space, I want to do away with this one. I want to do away with this one. Yes, the total asset in our case will be 15,800. I want to do away with this now. Yes. So then from this, we need to move. And basically, we record equity. So for the equity, we will start with the ordinary share capital. Ordinary share capital. And I hope you can be able to recall the ordinary share capital. We don't consolidate this. We only include the ordinary share capital, that of the parent company only. The ordinary share capital of the parent company only, which is how much? Which is 5,000. 5,000. Below that, what do we have? We have share premium. Equally, the share premium, we basically include that of the parent company only. That of the parent company only, which is 500. So below that, we have what? We have the retained earnings. So basically, retained earnings is one of the item which is a little bit tricky in terms of its computation. Maybe first of all, we can skip this one. We will come back and compute it. Then we will get what? We will get the total equity. We will get the total equity. And I hope you can also be able to recall your total in a part. These are some of the items you don't have to compute. And you end up maybe getting that figure wrong. So, but we will come back and compute. We will compute that. Then down here, after getting this, we also come and we compute something called the non-controlling interest. I'll be able to explain what is this in the process of computing that, but we will compute this as the last two items. Then from there, we need to proceed and we record liabilities. I think for liabilities, we have the current liabilities, but in this case, there is something we are going to introduce. We are going to introduce non-current liabilities. I hope you can be able to remember this deferred consideration. These are consideration to be paid by the parent company in future. So that deferred consideration will be recognized here as a non-current liability. And basically, I've said the value for deferred consideration at the end of the day is this one. We have amortized that. So this amount plus the interest for that year, which will give us what? Which will give us 2110. And then finally, we have the current liabilities. Current liabilities, we take those of the parent 3,000 plus 19, those of the subsidiary. And then you have now to recall that these include payables. Payables, we have amount of intercompany debt which should be adjusted from the payables. This one, 500. So that one should be deducted here, 500. So give me the final figure. Give me the final figure here. The final figure for payables for current liabilities. For current liabilities, I'm told is what? 44. Yes, 44. 44. So what I want us to do, I want us to compute these two items here very fast. Very, very fast. We should be able to do that in the next 10 minutes. We should be done. Yes, so we can start by computing what? Let's start by computing the group retained earnings. But basically, I've said, if, for example, you're doing that question in an exam, and basically you leave it like that, you should be able to get all marks. You should be able to get all the marks. So let's start by computing this one. The group retained earnings at the end of the year, that is carried down. That is carried down. That is carried down. So how do we compute this one? How do we compute this? So the first thing maybe you need to remember is the formula. How do we compute this? So this one is computed by taking the 100% of the parent company retained earnings plus for this company here, that is paper, we should take 80% of a post-acquisition retained earnings plus 50% of sisters. I've said 80% of paper, paper limited post-acquisition retained earnings plus 50% of sisters limited post-acquisition retained earnings. Yes. That's basically how we compute that. So what basically you should do is to have 3 columns for our companies here, starting with the parent, which is 𝐿𝐿, the subsidiary paper, and the joint venture sisters. And basically in this case, we will take what? We will take the retained earnings as given in the statement of financial position. So we go to the statement of financial position, we take the retained earnings balance carried down as given in the statement of financial position. So can you go to the statement of financial position of these 3 companies, specifically at the equity? At the equity, we're given the retained earnings of 𝐿𝐿, that 380. For paper, it is given as what? 1800, and for sisters is given as what? Is given as 12. So the first thing we need to do for these 2 companies, we are interested with the post-acquisition. So what we need to do for these 2 companies is to less the pre-acquisition. What? Acquisition. That does not apply to the parent. It only applies to these 2 companies. Yes. And I think for this, what we will do, for this company, I think for paper, we computed the pre-acquisition. The pre-acquisition retained earnings, which we have used in the computation of goodwill. How much was it? Give me that figure. We have computed the pre-acquisition retained earnings for paper. That is something we have already computed. Who can give me that figure? That retained earnings in tulitumia ku compute goodwill ya paper. Was it 1280? The one at the start? Yes. So this one we said is pre-acquisition. Is that the case? So pre-acquisition here need 1280. So we will less it there such that we shall be left with the post-acquisition. And then what about the sisters? Sisters When was it acquired? I hope you can remember when Sisters was acquired. Sisters was acquired 6 months to the end of the year here. Was acquired 6 months to the end of the year, 6 months to the end of the year. Basically, for Sisters, we need to have, first of all, its retained earnings at the end. Its retained earnings at the end for Sisters is 12, the value which we have here. Let's be together here. And then we also need to have the profit for Sisters for the year. That one, we get it from the income statement. From the income statement, the profit for the year for Sisters is 640. Silio? Yes. So can we first of all get the retained earnings here at the start of the year? So to get the retained earnings at the start, we will take this minus this, we get this. This minus this, we get this, which will give us what? Which will give us 560. So can we be able to get the retained earnings of Sisters on this date of it was acquired? Just like how we computed this, is quite simple. To touch this one at the start 560, and then we take for the whole year, which is 640. And here, because we have 6 months, we get half of this. We multiply that with 6 over 12. So we take 560 plus 320 plus 320 plus 320. That will give us what? That will give us, I hope you can see what I've done. I've taken the retained earnings of Sisters at the start, which you have said is this, minus this, which will give us 560. And then for me to compute its retained earnings on the date of acquisition, which is pre, I've taken the retained earnings at the start plus the profit for the year for this 6 months, just like what we did for the subsidiary. So, and I'm told that will give us 880. So now we get the post. Basically, I've said this does not apply to the parent. So what do we get here? Because of time and track variable, what do we get here? We get what? 5 what? 520. What about this one? We get 320. We get 320. Yes, 320. Then before now we apply these percentages, because this one we should take 100%, this one 80%, this one 50%. Some of the retained earnings here we need to be adjusted. As per the workings which you have done here, number one, we have this depreciation other charge, which we said should be deducted from the retained earnings of this company. So we have depreciation other charge to be deducted from the retained earnings of paper, which is 70 there. So this and this will not affect that, but we have this and it is profit, this one. We say this one will also be deducted from the retained earnings still of paper. So we have and it is profit that will also be deducted from the retained earnings of paper, 50, like that, like that. Do we have any other adjustment? I can't see any other. So we need to get the final figures. That is 380. This one 2400. This is 320. And then we get the group share of this. The group share. We apply now these percentages. This one for the parent we take 100. For paper we take 80. And for this company that is the Sisters, we take 50. We take 50%. 50%. So this will be 160. This will be 320. This one will be 3380. And then we add these two. We add those three values. We add those three values. That will give us the group retained earnings. The group retained earnings. I'm told that will give us 38.60. Basically, the computation for this is quite demanding, and that's why I'm saying, for example, if you're doing this question in an exam, I will not advise you to do this. I will not advise you to compute this. Yes. So maybe first of all, you can get the total equity before computing NCI. So this will be 55 plus 38.60, which basically give us 93.60. Finally, we compute the NCI. So the NCI is what? we'll talk about the NCI basically. This refers to the amount of money which is invested by the minority shareholders in the subsidiary. The capital invested by the minority shareholders in the subsidiary. Amount invested by the minority shareholders in the subsidiary. How do we compute the NCI at the year end to be recognized there as a component of equity? Now, to compute this, very, very simple. We take the NCI at fair value, the NCI at fair value, which is basically given in note 2. The NCI at fair value in note 2. How much is the NCI at fair value? The NCI at fair value in note 2 is what? Is 860. 860. I hope you can see that. And then to this, what we add here is something called the NCI share. NCI share law, the post that is of the NCI share of adjusted post acquisition retained earnings in the subsidiary company. So the NCI share of the post, that is the NCI share of the adjusted post acquisition retained earnings in the subsidiary. So where do we have this figure? The adjusted post acquisition retained earnings of the subsidiary. So that is basically the figure which we have here. This is the adjusted, this is the adjusted post acquisition retained earnings of the subsidiary, which is how much? 400 million. So we get the NCI share of that. The NCI share of this will be 20%. Will be 20%. 20% of that will give us what? That will give us what? That will give us what? Is it 80? Yes, it will give us 80. And then now to this, in case, for example, we had an impairment loss, the goodwill on acquisition was impaired. What we left here is the NCI share of impairment what? Loss. Was the goodwill impaired? No. No, it came to be a deducted share. So we add these two values and they give us 9 what? 940. So the NCI fair value here is basically 940. But basically I'm saying if, although these are some of the tips we will be able to discuss in the during our revision. So whenever you're doing that question in an exam, I will not advise you to compute this and this, because even without computing those two items, you'll have scored all the marks. Is our statement of financial position or balancing? It is not balancing. That is what I'm told. What is the difference? What have you omitted? $10. Or 10 bob. $10 bob. 10 bob is, where do we have that? Where do we have that 10 bob? Yes, I think it is. That one should be, is it interest? The interest on deferred consideration. No, that one is captured there. That one is captured there. That one is captured there. So you're saying the difference is the, what is the difference? Is the difference, is it 110? 110? Yes, I know where that one should be captured. That one basically should be deducted from the retained earnings of the parent here. Because that is an interest or is basically an expense which the parent company was supposed to have accounted for. But if you check on the income statement, the parent company had not accounted for the interest on this. So that one should also be adjusted here. The interest on deferred consideration it should be deducted from the retained earnings of the parent. Deduct that here. Deduct that here. It was supposed to be accounted for as an expense by the parent, but the parent company had not accounted for that in the income statement. Was it accounted for by the parent company? No. So that's why it should be deducted there. 33, 80 minus 110. So now this one should be 32, 70. And the retained earnings should be 37.50. Yes, it should now balance. It should now balance. It should now balance. Is it not balancing? Yes, it should balance. So I think that is what you have forgotten here, because remember, these are an expense which the parent company was supposed to have accounted for. It the parent company needed to recognize this as an expense, and that's why you can see in the income statement the parent company didn't have a finance cost. That was there, and therefore even the profit which you have taken into account here, that was supposed to have been deducted, and because it was not deducted, that's why we're deducting it here. Sasa, yes. So basically, this is what was required as far as that question is concerned. And I'm saying this is one of the easiest questions which has ever been tested in advanced financial reporting in relation to the group account. In relation to the group what? Account. And there is a question which I'll give you there as an assignment. You attempt it. Because now what I want us to do once we meet in our next class, we are looking now on special cases in group accounts. We will start by looking on the aspect of piecemeal acquisition. We do a question, just a small discussion, and then we do a question. In our next class, that is what we will do. That is on Tuesday. Then on Wednesday, we will be able to look on how we account for the disposal of interest. And then on Saturday, we do foreign subsidiaries. So basically, we should be done with this next week. What we will be remaining with is the group cash flow. Is the group what? Cash flow. So because we have those three concepts which are remaining: piecemeal acquisition, the disposal of interest, and the foreign subsidiary. We will be able to take one class each, but basically we will be able to come back and look on this during our revision. So the question I want you to attempt is the question for December. The question for December 2022, which basically is question number 3. Question number 3. I want you to attempt this one. Maybe during our revision, we will be able to look on it. We will be able to look on that. We will be able to look on this. We will be able to look on this. Remember, what we said is that if everything goes on well, we should be done at least with this by next week, our first class. And then from there, I think what will be remaining is maybe the theories and maybe like the financial statements of the insurance company. Right now, we can say that we are almost like over 85% done with the syllabus. So I'm hoping that if everything goes on well, we should be done with this by next week, but one on Tuesday. On what? Tuesday. So let's stop at that point for today. You have a nice weekend, and make sure you attempt that particular question. In case you come across any challenge, you can maybe get some assistance from me. Equally, if you're able to attempt the question, you can send it to me. I'll be able to check on it and give you the feedback. Sasa, yes, we stop at that point. Have a nice weekend. See you next week on Tuesday. And therefore, in today's class, I want us to start on this topic number 1. And the topic is nature and the classification of companies. So as far as this topic is concerned, we said that we are going to discuss a number of issues as far as the company is concerned. One, we will start by defining what is a company. And then from there, we look on basically the various characteristics or features of the company. And then from there, we look on basically the classification of companies. How do we classify companies? Because generally, we do have different types of companies. We are going to look at those different types of companies. But in this case, I want us to start by defining what is a company. And basically, in this case, when we talk about a company here, this one can be defined to be an association, of persons, which is basically formed for some lawful common purpose and also registered in accordance with the Companies Act of 2015. So therefore, this is what is association of what? Of persons. Association of what? Of persons, which is basically formed for lawful common purpose, and also registered in accordance with the Companies Act of 2015. So that is the definition of a company. So what do you mean by association of persons? Association of persons, basically, this whereby, for example, we may agree to come together and basically we start doing business together. We start doing business together. So therefore, association of persons, this basically whereby we have a number of individuals, 2 or more persons will come together. They agree to register a company in order to undertake some business, which by the end of the day is legal, or basically a business which is what? Lawful. So that is basically the definition of a company. And basically, in this case, we are saying that this particular association of persons, by the end of the day, it has to be registered in accordance with the Companies Act of 2015. Because if, for example, today we have agreed maybe to carry on a business, and that business will be conducted in form of a company. So by the end of the day, we must register that company in accordance with the Companies Act of 2015. And I hope you can also be able to recall what we said in our previous class. Previously, companies were registered in accordance with the Companies Act, Companies Act, Cap 486, but this particular act has been scrapped and basically replaced by the new Companies Act, that is Companies Act of 2015. You may come across some old notes which are basically talking of Companies Act Cap 486. So that act has already been repealed. Basically, it has been done away with and replaced by the new Companies Act of 2015. So today, if you to register a company, either a private company, a public company, you must register that company in accordance with the provisions of the Companies Act 2015. Now, this act here, that is the Companies Act of 2015, Companies Act of 2015, basically provides some legal framework, regarding number 1, the formation of the company, formation of the company. How should a company basically be formed? So that is clearly stipulated under the Companies Act of 2015. It also clearly stipulates issues to do with the management of the company. How should the management of the company be, or who should manage the affairs of the company, and how should those particular affairs of the company be managed? That is also something which is clearly stipulated under the Companies Act of 2015. And also we have the aspect of liquidation. So liquidation, remember yesterday I said that liquidation basically is the legal process through which the legal existence of the company is brought to an end. That is also something which is provided for under the Companies Act of 2015. How can a company be liquidated? What are the grounds for liquidating the company? And maybe the various types of the liquidation. Now, in this case, other than the Companies Act, which basically talks about the formation of the company, the management of the company, the liquidation of the company. So we also have various, or basically we have case law, or we have various case law. In this case, when we talk about case law, this in other terms we refer to it as the judicial precedent. So what do you mean by the judicial precedent? The judicial precedent, basically, these are those particular rules. Or principles, which the judges will come up with. After basically deciding various cases. So mean that other than the formation of the company, the company's management, and also liquidation being governed by the provisions of the Companies Act, we also have various rules and also principles which have been formulated by the judges, also which basically provide some legal provisions regarding the formation, management, and also the liquidation of work of the company. Therefore, we say that in different topics, we will basically come across various rules or basically various principles which have been formulated by judges and which basically governs the aspect of forming the company, management of the company, and also the liquidation of work of the company. But majorly, most of the provisions regarding the formation of the company, regarding management, and also regarding the liquidation of the company, they are basically contained under the Companies Act of 2015. And therefore, most of the things we will discuss in this unit here, they are purely contained in the Companies Act of 2015. Now, in this case, we can proceed and look on what are the features or basically what are the characteristics of the company. So let's look on the features. Take into account, we have already defined what is a company. We look on the features or basically the characteristics of a company. What are the features or basically what are the characteristics of the company? Number one, we can talk of something called the separate legal personality. The separate legal personality. Separate legal personality. So basically what this means is that once, for example, you come together and maybe you have registered a company with the registrar of companies, that company becomes a legal entity, which is separate and also distinct from its members and also its directors. So once a company has been registered here with the person called the registrar of companies, in this case, we say that there exists a kind of a shell or basically a kind of a shield which basically separates this company from its members and also its director. So what that means is that if today we have agreed to register a company, once that company has been registered with the registrar of companies, the company becomes a legal entity. That's why you see that a company is legally recognized to be having the same status just like you. So if you register a company today, that company has to pay tax to the government just like you. That company has the capacity to enter into a contract just like you. So once, or basically what that means is that once a company has been registered, once the company has been formed, a company becomes a legal entity, separate and also distinct from its members and also from its director. So a company is not the same with sole proprietorship business, because if today you form a sole proprietorship business, that business is basically viewed to be the same with the owner. So if, for example, we come together, we form a partnership business, that partnership business is not separate from us as the partners. So that's why you see that if the partnership business is not able to pay its debt, the partners must come in and know how those particular debts will be paid. But in case of a company, if we register a company today, a company has that aspect of the separate legal personality. If the company is not able to pay its debt, those are not our debts as the members. So if the company has maybe entered into a contract, that is not our contract. If the company has some assets, are those our assets? No. So therefore, that is one of the characteristics or basically one of the feature of the company. Number two, we say that the company has something called the limited liability. The limited liability. Limited liability basically means that if, for example, the company is not able to pay its debts, then the members of the company will not be required to come in and do what? Contribute money to pay the debts of the company. So in other terms, this means that the liability of members in a company is what? Is basically limited. It's actually what? Limited. So if the company is not able to pay its debt, then the members do not have any responsibility as far as the payment of those particular debts of the company are concerned. In other terms, we can say the debts of the company are not the debts of who? Of the members. So the members cannot be called upon to come in, contribute money to pay what? To pay the debts of what? To pay the debts of the company. So the other feature, or basically the other characteristic of the company, is something called number two. Also, number three, that is number three, we have what? We have perpetual succession. Perpetual succession. Perpetual succession, or basically you can refer to this as permanent existence. Permanent existence. Permanent existence. What does this mean? Permanent existence. It basically means that once a company has been registered, a company based or the life of the company is continuous. Because when we talk about something or continuous, this is another name for, sorry, perpetual is another name for continuous. The life of the company is continuous. The life of the company is continuous, or basically the life of the company is what? Perpetual. What this means is that if, for example, something happened to a member, or basically then a number of members, that do not in any way affect the company. that do not in any way affect what? The company. A company cannot be liquidated because maybe something has happened to a member. For example, maybe one of the member has died, or maybe one of the member has exited the company, No. So the life of the company is continuous. So once the company is formed, even if, for example, some of the members exit, some of the members are declared bankrupt, some of the members die and they leave the company, that do not in any way affect the life of what? Of the company. It's not like a sole proprietorship business, whereby if the owner dies, that can lead now to the closure of that what? Business. Equally, like what happened in case of partnership. If maybe one of the partner dies, one of the partner maybe retires, that can lead to the dissolution of a partnership. That is not the case when it comes to the company. The life of the company here we are saying is what? Is continuous. So if a member exit or something happened to the member, that do not in any way affect what? The life of what? Of the company. Number 4, we can say the company has got something called the common seal. Common seal. So when talk about the common seal, this is basically equivalent to the company seal. By saying that the company has got a company seal or a common seal, it basically means that the company has the capacity to sign its documents, to sign its what? Its document, to sign its what? Its document. So for any legal document to be deemed to be authentic, that document must be having a company seal. So therefore, a company has a common seal. The company, or that means that the company has the capacity to sign its own document. And take into account the company itself does not have, or basically the company do not have that ability to sign, basically to sign the document. Any document of the company, for it to be authentic, we are saying it must be having what? A common seal. A common what? A seal, or a company seal. So the other feature of basically the company number 5, we can say that the company has the contractual capacity. The company has got contractual capacity. Contractual capacity basically is the ability to enter into contract. The ability to enter into contract. The ability to enter into what? Into contract. The company has the capacity to enter into contract. But basically, those contracts which are entered into by the company, are they entered into by the company itself? No. So any contract which is entered into by the company is entered into by its directors. By its who? By its directors. By its directors. So the directors are the ones who enter into contract on company's behalf. But by the end of the day, those are contract of the company. They are not contract of directors, because the directors here were acting as the agent of the company. They were acting as what? As the agent of the company. They were acting as the agent of what? They were acting as the agent of the company. So number 6, we can say the company can sue or be what? Or be sued. The company can sue or be sued. It basically means that the company here can go to a court of law, take a legal action on behalf of, or basically take a legal action against a third party. And generally, the company here, or the person who will be going to a court of law to take that legal action, is basically like the management, the directors, or maybe the company's lawyer instituting a legal action on company's behalf. The company can sue in a court of law or can be sued in a court of law. So number 7, we can say here, the company has capacity to own property. Capacity to own what? To own property. The company has got the capacity to do what? To own a property. So just like a natural person, the company has the ability, has the capacity to own the property. In fact, those particular property, those particular assets which are in a company, they are not assets of the members. They are basically what? They are basically the property or asset of the company. Simply, in this case, we have said that there is that aspect of the separate legal personality. If we have come together, we have formed a company. Those assets which exist in that company, those property which exist in that company, they are not our own asset, but basically they are assets of who? Of the company. So then the other feature of the company we can say is there's something called voluntary association. Voluntary what? Association. Voluntary association. So in this case, a company here, remember by definition, you have said is an association of persons. Association of persons. That association is voluntary. You can't be forced to be a member of a company. It's a voluntary. You must voluntarily accept to be what? Maybe to be a member of a company. You can't be forced. You can't be what? You can't be forced. The other, as far your shares. Though in private companies, the transfer of the shares is restricted. The transfer of shares is what? Is restricted. So restricted in the sense that you cannot be able to transfer your shares just to any other person. Just to any other person. You wake up today and maybe you decide that you'll sell your shares to any other person. There is some restrictions in relation to that. For example, in a private company, the requirement is that if you want to transfer or you want to sell your shares, you can only sell those shares to the existing members. You cannot sell the shares just to any other person. So the shares can only be transferred to the existing members. But basically, we are saying that there is that transferability of interest. You can be able to transfer your shares in a company. So the other feature of the company, maybe number 10, we can talk over the aspect of management. The aspect of management. So the aspect of management. So who manage the company in this case? Who manage the company? So the companies basically are managed by an organ which is known as the board of directors. These are basically a feature which applies to all companies, that companies are managed by a board of directors. By a board of what? A board of directors. By a board of what? A board of directors. This board of directors basically comprises of directors who are elected by the members to be in charge of or basically to manage the affairs of what? To manage the affairs of what? Of the company. So therefore, this basically, among others, are some of the features or basically some of the characteristics of a company. Some of the features or characteristics of what? Of the company. So basically what that means that if you go to different companies, you'll be able to see those particular what? Features. So those features applies to various companies. So now, next, I want us to look on the classification of companies. Or basically we look on the different types of companies which we have. Classification of companies. Classification of companies. And I hope you're together up to that point. Are we together up to that point? Are we together up to that point? Are we together up to that point? Catherine, are we together? Steven, are we together up to that point? Yes. Yes, so we are together up to that particular point there. Can see someone is having a question here. Yes, so I think we're going to discuss on that case of salmon versus salmon, maybe somewhere. Catherine, we're going to talk about the case of salmon versus salmon and the company limited. Almost at the end, there is somewhere we're going to look on the doctrine of separate legal personality in details, almost at the end of this topic. So we will discuss more on that. Okay, so classification of companies. Now here we have various ways in terms of how companies are classified. Various ways in terms of how companies are what are classified. Various ways in terms of how companies are classified, or in other terms, we can say we have different types of companies. So number one, we have the statutory corporations. Statutory corporations, or in other terms, these are known as the parastatos. So what do you mean by the statutory corporations or parastatos? So these are those companies which are basically formed pursuant to a certain act of parliament or in accordance with a certain act of parliament for them to be able to provide some essential services to the members of the public. And these companies here, usually they are under the control of the government, or they fall under the public sector. They fall under the public what? Sector. Public sector entities are those entities which are basically established to provide essential services to the members of the public. And on the other hand, they do not operate with an objective of making what? A profit. So therefore, these are those companies which are formed in accordance with a certain act of what? Of parliament. A good example of this is CASNEP. A good example of this is 𝐎𝐻𝐋𝐈𝐍. If you do some research, you'll be able to see that 𝐎𝐻𝐋𝐈𝐍 is a statutory corporation which is formed in accordance with the Accountant Act, which is formed in accordance with the Accountant Act. Now, on the other hand, we have seen that these particular entities are basically formed to provide essential services to the members of the public, to the members of the public, meaning that these particular entities, these companies are not formed with an objective of making profit. With an objective of making what? With an objective of making profit. And therefore, these particular entities will basically continue operating even if they are making losses. They are making losses because we are saying that their main objective is to provide some essential services to the members of the public. Now, in case they make any profit, that profit may be plowed back, may be reinvested back, or that particular profit may be paid to the government as dividends. Remember, these entities are under the control of the government. So if there's some of the parastatals basically make good profit, and basically what they do, they pay part of the profit they are making to the government as well as dividend. So we are saying the profit they are making can be plowed back, can be reinvested back, or can actually be paid to the government in form of what? In form of dividends. So how is their capital raised? How do these parastatals raise their capital? These parastatals basically raise their capital through borrowing, and basically that borrowing is guaranteed by the treasury. So the government or the treasury is actually the guarantor. In case these parastatals are not able to repay back the amount of capital they had borrowed, who is supposed to pay that capital is automatically the government. So then from there we have the other type of company, and that is basically the registered. In other terms, you also refer to this as incorporated companies. Incorporated companies. Now, when we talk about the incorporated companies, incorporated or the registered companies, number one, these are those companies which are formed in accordance with the Companies Act of 2015. They are formed in accordance with the Companies Act of 2015, and therefore, in a private company, the public company, and so on, they are good examples of the registered or the incorporated company. So these are those particular companies which will be formed and also registered in accordance with the Companies Act of 2015. So after these companies have been registered, after they have been registered with a person called the Registrar of Companies, they will be issued with a certificate of incorporation. They will be issued with a certificate of what? Of incorporation, in which case then these particular companies shall be regarded to be separate legal entities from their members and also from their shareholders. Shareholders. And actually, these companies here, their powers and also what they do, that is something which is clearly defined under their constitutions. And basically, these two companies, they have two main types of constitution. The first constitution is known as the Memorandum of Association, and the other constitution is known as what? The Articles of what? Of Association. So in other terms, you can say that they derive their powers from these two constitutions, the Memorandum of Association and also the Articles of what? Of Association. So then from there, we can proceed and look on the other type of companies, number 3, and that is the chartered corporations. Chartered corporations. Now, chartered corporations, these are those particular companies which are basically formed upon being granted a charter, basically by the president. Usually, the companies which fall under this category are universities. Are what? Universities, because basically what we know is that for any university to be able to offer various programs, various certificate, diploma, degree, master programs, it can only be able to do that upon being granted a charter. Upon being granted a charter by who? By the president. By the president, who is basically empowered to do that under something called the Universities Act. The Universities Act, the president is empowered to grant a charter to a university if, for example, the president will be is basically of the opinion that that particular university will basically do what? Help the country in terms of development and promotion of what? Of education. So therefore, these are those particular companies which are basically formed upon being granted a charter by the president, who we have said is empowered to do that under the Universities Act. And I've said good examples of this are what? Are the universities. Are what? The universities. Then from there, we have number four. Number four, we can talk of private companies. We can talk about private companies, or private company, basically. A private what? A company. So private company here is actually defined under the Companies Act, because one, a private company has to be formed in accordance with the Companies Act of 2015. And the Companies Act of 2015 defines a private company as what? Or we can say a private company. This is a company which by its articles of association, of association. So when talk about the articles of association of a company, articles of association of the company, this is actually an internal constitution of the company. An internal constitution means that this is a document which contains some rules and regulations regarding how the affairs of the company will be managed, regarding how the internal affairs of the company will be will be managed. So this is defined to be a company which by its articles of association, number one, restrict the right of members to transfer shares. Restrict right of members to transfer what? To transfer shares. So if, for example, you're a member of a private company, your right to transfer shares is usually restricted. So what does that mean? It basically means that if, for example, you want to transfer, or in other terms, to sell your shares, so there is some restrictions as far as that is concerned. And I think I've given a good example that if, in case you want to sell your shares in a private company, you can only be able to sell those particular shares to the existing members. You can't sell those particular shares to just any other person. So number two, we say, is a company which by its articles of association limit the number of members to 50, limit the number of members to what? To 50. Limit the number of members to 50. The number of members in a private company cannot exceed 50. And number three, is prohibited from inviting members of public to buy its shares, or in other terms, to subscribe its shares or debentures. So it basically means that in case a private company wants to issue shares, it can only be able to issue shares or even debentures to the existing members. It cannot be able to invite the members of the public to come and buy its shares or debentures. So therefore, this is the definition of a private company. So we have said it's a company which by its articles of association, number one, restricts the right of members to transfer shares, limits the number of members to 50, and number three, it is prohibited from inviting the members of the public to subscribe its shares or debentures. Its shares or what? Or debentures. Now, before we proceed to look on the other company here, we can proceed and look on the other features, or maybe we proceed and look on more features, or basically the various characteristics of this company, because it is important for you to note that this is basically one of the common type of a company which is basically formed by individuals to do business. In most of the cases, if today you want to register a company as an individual, you will be registering a private company. You'll be registering a private company. This is therefore one of the common type of company. So one of the features of this company, number one, is that private companies have a minimum, or basically in other terms, you can say, must have a minimum of one member and one director. One member and one director. So according to the new Companies Act, or basically according to the Companies Act of 2015, so for this company to be formed private company, it requires a minimum of one. But the repealed Companies Act, that is Companies Act Cap 486, it was requiring a private company to have a minimum of two members. But today, as an individual, you can register your own company as a single individual. So it requires a minimum of one member and one director. One member and one director. So that is one feature of this private company. So the other feature of the private company, we can say that this company can basically commence business upon incorporation. Incorporation is basically the process through which a company is registered with the registrar of companies. So once this company has been registered with the registrar of companies, remember you have said that the registrar of companies will issue something called the certificate of incorporation. That company can start to operate upon receiving that certificate. But we will be able to see if, for example, you are registering a public company. For that company to start operation, it's required to get another certificate still from the registrar of companies known as a trading certificate. But this company, once registered, issued the certificate of incorporation, it can be able to, or it can or it can commence business. So the other feature of this company, I think that is something I've mentioned here. It restricts the right to transfer shares. Right to transfer what? Right to transfer shares. So if you are a member of this company, your right to transfer shares is restricted. Now, this restriction for the transfer of shares is achieved in two ways. In other terms, you can say that this restriction regarding the transfer of shares is restricted in two ways. One is through something called director's discretion. Director's discretion. Basically, what this means is that, or basically this document here, that is the Articles of Association, which you have said is an internal constitution. We have said it basically requires that in case you want to transfer your shares, to transfer is basically to sell your shares. So in case you want to transfer your shares in a private company, you must first of all inform the directors of that company. Inform the directors that you want to sell your shares. Now, once you have informed the directors are empowered by this document, by the internal constitution, basically to do what? To decline you, or basically the directors do have that particular power not to give you a permission, or basically a consent to go ahead and basically do what? Sell your shares. They can tell you that you will not sell your shares. You'll not do what? Sell their shares. In other terms, once you have informed them you want to sell your shares, they can decline to register that transfer of shares. So once they have declined to register your transfer of shares, it means that you can't be able to go ahead and you do what? You sell your shares. So that is one way through which the free transfer of shares is restricted. Number two, it is also restricted through something called the pre-exemption clause. Pre-exemption clause. So this is still a clause which is contained in this document, Articles of Association, and which basically requires that in case you want to sell your shares in a private company, you must offer for sale those shares to the existing members. You can't offer for sale those shares to just any other person. This clause requires that you must offer for sale all the shares to who? To the or basically you must offer for sale those particular shares to the existing members of what? Of the company. This particular clause is meant to ensure that in case you are selling your shares in a private company, you are not just selling those shares to any other person, but basically you are selling those shares to who? To the existing shareholders of that company, to the existing shareholders of that wood, of that company. Yes, so those are basically two ways through which now this free transfer of shares is actually what? Is actually restricted. Maybe we can also say that or the other feature of this company here, number 4, we can say limit the number of members to 50. Limit number of members to what? To 50. So the number of members in this company cannot exceed what? 50. Cannot exceed what? 50. So those are basically some of the features of this private company. So then we can proceed and look on the other type of company. Remember, this was under number 4. So number 5, we have public company. Public company. What is a public company? Public company is also defined under the Companies Act. And the Companies Act defines this, or we can say that a public company, this is a company which by its articles of association, number one, do not restrict members' rights to transfer shares. Members' rights to do what? To transfer shares. So in a public company, the right of members to transfer shares is not what? Is not restricted. And number two here, we can say that this one is not prohibited from inviting members of public to buy its shares. Not prohibited from inviting the members of the public to do what? To buy its shares. So this company can invite the members of the public to buy, or in other terms, to subscribe its shares or debentures. And we will be able to see that whenever a company is inviting the members of the public to subscribe its shares, that company does that by issuing something called a prospectus. By issuing a prospectus. A prospectus is any invitation by the company to the members of the public to buy or to subscribe its shares or what? Or debentures. Number three here, we can say its certificate of incorporation. Each certificate of incorporation clearly states that it is a public company. States that it's a public what? Company. So this is the definition of a public company under the Companies Act. Under the Companies what? Under the Companies Act. Specifically, if you go to, and this is a document, in fact, you should be able to download. If you go to any browser, you type Companies Act of 2015 PDF document, you should be able to get this act. Yes, so it's good you have this particular act, because I've said most of things we are running here, they come from this act. Specifically, for example, in this case, if you download this act and you go to section 10, of this act, this is where you get this definition. That's why you get this word definition. Yes, that's why you get that definition of a public company. Now, in this case, it is also important. There is something I've mentioned here in relation to the features of the private company here, where we have said a private company can commence business upon incorporation. Once a company is incorporated or registered with the registrar, it will be issued with a certificate of incorporation. We have said that this company can be able to commence business upon receiving that certificate. But this one, that is a public company, it can only be able to commence business after receiving another certificate called a trading certificate. Trading certificate is not a business permit, because some students tend to confuse this with a business permit. A business permit is you get that from the county government. So, but a trading license, this is still a license which is issued by the registrar of companies. But a company is only issued with that certificate, and that only applies to public company once the company has been able to raise something called minimum subscription. Minimum subscription is basically the minimum amount of capital which is required by the company for its operation. Once this company has been registered with the registrar of companies, it is required to issue a prospectus inviting the members of the public to start buying its shares so that it can raise the necessary capital. So automatically the directors will have said that, or basically will have agreed on the minimum capital required by that company. So once that capital has been raised, the minimum capital required has been raised through the issue of shares to the members of the public. That is the only time the company can be able to start operation. And once the company raises that amount of money, it is required to notify the registrar of companies that they have been able to raise the minimum capital required. Once the registrar is notified, then the registrar will proceed and issue that company with another certificate called a trading certificate. Upon the receipt of that certificate, that is the only time a public company can be able to start operation, operation. And therefore, that capital, minimum capital required, which you're referring to as the minimum subscription, is the amount of capital required by the company to pay the preliminary expenses. Preliminary expenses are the expenses which are incurred during the formation of the company. If today you are forming a company, kuna zile expenses uta-incur. So maybe you need to pay, there is something called a stamp duty payable to the government. You also maybe the registration of or the formation of the company maybe is done by your lawyer. So he will be charging with some small fee. So all those costs you incur in registering a company, refer to them as preliminary expenses. So minimum subscription must be enough to pay preliminary expenses, must be enough to pay for any asset or property acquired by what? By the company, must also be enough to provide the company with sufficient working capital. So working capital is basically money required for operation, but maybe buying inventory, paying the day-to-day operating expenses of the business, and so on. So therefore, once this company has been able to raise that amount of money, it is supposed to notify the registrar about the same, and basically the registrar will issue that company with a trading certificate. A trading certificate. That is the only time this company can be able to start or operating. Yes. So are we together up to that point? If we are together, want us we move to the next thing. Are we together up to that point? Catherine, Steven, Zido, are we together up to that point? Are we together up to that point? Okay, so I want us next we look on what? We look on the features, not the features, Lana. I want us to look on the differences between these two types of companies. Differences between the private and the public. Private and public companies. So what are the differences? Which differences exist between these two companies? Which differences exist between these two companies? Remember, I've said these are the common types of companies which are formed by individuals to do business, either private or public companies. So which differences exist between these two companies? I think we have mentioned, we have come across some differences, like this one require a minimum of one member. For it to be formed, it requires a minimum of one, whereas these require a minimum of 7 members, a minimum of 7. So this requires a minimum of one director, whereas this one requires a minimum of 2 directors. 2 what? 2 directors. The other difference is that this company, that is private company, is not required to hold an AGM. As per the Companies Act of 2015, a private company do not have any mandate, do not have any responsibility of convening. It may hold an AGM, but it's not a requirement under the Companies Act. But this company here must convene an AGM, and actually we will discuss more on these meetings, on this meeting, AGM, in the topic of companies meeting. We will see what is an AGM, when is AGM supposed to be held, and basically which business are doing such meeting. So the other difference is that this company here, we have said, can commence business after receiving certificate of incorporation. This company, for it to commence business, we have said, other than receiving this certificate of incorporation, it must additionally receive a trading certificate. The other difference is that private company here, basically have said restrict the right of members to transfer shares. Restrict the right to transfer what? Shares. But this one does not do what? Does not restrict. This one does not restrict the right of members to do what? To transfer shares. Does not restrict the right of members to transfer what? To transfer shares. On the other hand, this one cannot invite the members of the public. Cannot invite the members of the public to buy shares, whereas this one can do what? Can invite the members of the public to buy its shares. Can invite the members of the public to buy its what? Its shares. Can invite the members of the public to do what? To invite or basically to subscribe its shares. Maybe the other difference, we can say private company. Here, the directors are not required to obtain shares. are not required to obtain the qualification what? Shares. So the qualification shares generally, these are the shares which of the public company are required to obtain and pay within a period of 2 months from the date they were appointed. So that applies to directors of public companies. So here the directors are not required to qualification shares. The directors are required to do what? To obtain the qualification what? The qualification shares. So those are some of the differences which exist between the private company and also the private company and the private and the public company, private and public company. So next, I think we can look on like the advantages of a private company over public company. So what are some of the advantages of a private company over public? So we have a number of advantages. One, we can say that this company, private company, can be able to commence business upon incorporation. So once this company is registered with the Register of Companies, it can be able to commence business. It can start operating, not required to obtain trading certificate. That is one of the advantages, because for this company to start operation, other than being issued with a certificate of incorporation, it must then wait and acquire the other trading certificate. Now, the other advantage of this company, for it to be formed, it requires a minimum of one. Meaning that to form a private company is much simpler, because just one person is what is required. So the other advantage of this company, that is a private company, this company is not subjected to publicity requirement. What does that mean? It basically means that this company here is not required to, for example, one, publish its financial statements, make its financial statements available to the members of the public, which applies to public company. Public company must publish its financial statement, must make its financial statements available to the members of the public. Equally, public company, most of its documents, including MOA, AOA, and public documents, they are documents which can be accessed by any member of the public, which does not apply when it comes to what? When it comes to companies. So the other advantage of this company is that private company is not required to hold an AGM. Remember, this is an advantage, because if a company has to convene an AGM, we know that there are some costs which will be incurred, some logistical costs which will be incurred. The company must get up. Maybe the company will need to be, the company need to have other logistics. All that means that the company will have to incur some expenses. On the other hand, if, for example, this company, the public company, fails to convene this meeting as required under the Companies Act, it can be fined. It can be required to pay a fine to the registrar, because it is not complying with the requirements of the requirements of what? The requirements of the Companies Act. So those are basically some of the advantages of a private company. But on the other hand, we have various advantages of a public company over private. So what are some of the advantages of public company over private? One is access to capital. So if these two companies want to raise capital, the company which can be able to raise capital very fast and easily is the public company, because this company can issue shares to the members of the public, unlike private company, which is restricted from issuing its shares to the members of the public. So we can talk of easy access to capital. Number two is something called easy exit strategy. So if you have invested in a private company, it is basically easy to exit, because you can just be able to sell your shares anytime and to any other person, unlike in a private company whereby your exit shares are issued to so many shareholders. So the risk has been spread to so many shareholders, unlike in a private company whereby shares are issued to maybe few individuals, to few individuals. And the other one is about the ease of selling the shares. Ease of selling the shares. If you want to sell your shares, you can be able to do that with ease. And there is no much restrictions in relation to that, in relation to that. Yes, yes. So that basically the advantages of the what of the public company over private. Now I want us to take a short break. I think we can just take a short break of 10 minutes, and then we come back. We look on the remaining types of companies, the other types of companies, and maybe we will wind up by looking on. We see whether we will be able to wind up on this. But basically, I want us first of all we take a short break, then we come back after that short break of 10 minutes. We come back at exactly 1:18. We continue. Yes, so let's continue. I hope you're back. I hope you're back. Yes. Are you back? Catherine, Stephen, Zido, are you back? So that we continue. Are you back? Are you back? Okay, so I want us to continue with the discussion here. And I think we have just discussed on some of the advantages of a private company over public, and also the advantages of a public company over a private. So next, I want us to look on the other type of company, number 6, and that is the unlimited company. So unlimited company is what? So unlimited company basically is that particular company where the liability of members is unlimited. What does that mean? The liability of members is unlimited. It basically means that if, for example, this company that is not able to pay its debt, then what will happen is that the members of such a company will be required to come in and contribute money to pay those particular debts of the company. So meaning that this company here is just the same with a partnership, is the same with a sole proprietorship business. So the only difference is that this company one will be having perpetual succession, and also the company will be having the separate legal personality, but the liability of members is unlimited. Number 7, we have company limited by guarantee. Company limited by guarantee. And the company limited by guarantee, number 1, these are those companies share capital, do not have share capital. Actually, this company have like 3 features. These companies, number 1, do not have share capital. What does that mean? It basically means that this company do not raise capital by issuing shares. Simply because mostly company limited by guarantee are the not-for-profit making organizations, like the NGOs which are formed, they fall under this category here. And basically what we know is that NGOs rely on donations. They are funded by donations and also maybe grants from the government. Maybe, for example, the government a grant. They do not have share capital. They do not raise capital by issuing shares. Number two, these particular companies here are not formed to make profit. Not formed to do what? To make profit. They are not formed to make what? A profit. And that's why I've said NGOs, they fall under this what? Category. And number 3, these companies or the liability of members. The liability of members is limited by what? Is limited by guarantee. Is limited by what? By guarantee. So by saying that the liability of members is limited by guarantee, it basically means that when these companies are basically to be formed, each member of this company basically make a commitment that in case the company is not able to pay its debt, then they will come in and contribute a certain amount of money to help the company in terms of paying its debts. So if you are a member here, so during its formation, you must commit yourself to contribute a certain amount of money to help the company in terms of paying its what? Its debts. That's what you mean by the liability of members being limited by what? By guarantee. So these are basically the 3 features of these particular companies here, which are company limited by what? By guarantee. So then we can proceed and look on the other type of, or the other classification of a company. That was number 7. Number 7. So we have number 8. Number 8, and that is the company limited by shares. Company limited by shares. So when talk about the company limited by shares, these are those particular companies where the liability of members is limited by shares. The liability of members, liability of members is limited by shares. Is limited by what? Is limited by shares. So what this means is that in case this particular company is not in a position to pay debts, then as a member of this company, you will only be required, or basically as a member of this company, the obligation which you have as far as the payment of those debts of the company is concerned is paying the amount of money which you have not paid on the shares you have been issued with. For example, you have been issued with 10,000 shares. Maybe there is some amount of money you have not paid for those shares. So what you'll be required to do in this case is you pay that amount which you have not paid on your shares to help the company to raise money to pay its debts. That's basically what you mean by your liability being limited by shares. Your obligation as far as the payment of the company's debt is concerned is limited to paying any amount of money unpaid on your shares. If your shares are fully paid, then can you be required to come in and pay any amount of money here? Automatically, no, because your shares are free. That's what you mean by company limited by what? By shares. So then from there we have a holding company, holding and a subsidiary company, holding and subsidiary company. I think in this case we can start by defining what is a holding company. So holding company, essentially this is a company which has acquired the majority of the shares in another company. For example, we are told 𝐻 Limited has acquired more than 50%. That is the majority of the shares in B Limited. This company here is the one company, the holding company. In other terms, this one is also called the parent what company, the holding or the parent company. For us now, this company here is called the subsidiary company. It's called the subsidiary what company. So, but by definition, how do we define a holding company? So a holding company, this one is defined under the Companies Act, specifically Section 3 of the Companies Act of 2015. And actually, a holding company will say this is a company. Basically, we have 4 definitions. Is a company that number one controls the composition of the board of directors, control the composition of the board of directors of another company, controls the composition of the board of directors of another company. So a company is said to control the composition of the board of directors of another company if that company is the one which appoints majority of the directors. For example, A Limited, taking into account its whole majority of the shares in B, A Limited will be the one which appoints majority of the directors of B Limited. It therefore controls the composition of the board of directors of B what? Limited. Number 2, we say is a company that do what? That controls more than half. Controls more than half of the voting rights of another company. Voting right of another company controls more than half of the voting rights of another company. If A Limited hold majority of the shares in B, it basically means that A controls more than half of the voting rights in B in B Limited. And number 3, holds more than half of the issued of the other, that is of the other company, of other company share capital. Other company share capital. So this company holds more than half of B Limited share capital. So therefore, this is the parent, whereas B is what? Is a subsidiary. And then number four here. Number four, we can say it is the whole of a company. It is a holding a company of a company that is of a company, okay, of a company which is another company holding company. So what have we said here? We have said that the holding company is a company that is a holding company of a company which is another company holding company. What does that mean? Just that so that you understand. Assuming you have the which basically has acquired more than 50% of the share by B Limited, and then this one more than 50% by who? By C. So in this case, you can see A controls B. This one has or basically acquired more than 50% of B, and then B in turn control C. So this company control this, and this in turn control C. So therefore, in this case, we can see A has got some indirect interest, not indirect interest, indirect over C. A Limited has over C. So therefore, will be a holding company as far as companies. So this definition number 3, definition number 4 of a holding company, basically it applies to this, where we are is a holding company of company C. Sim A is a holding company of a company, is a holding company of a company which is another's what? Holding company. So one of this, which in turn is a holding company of another company. So this is a holding company of company what? What is the definition of what we refer to as a holding company? So if you come across a question required to define a holding company, you need to remember those 4 definitions. Those 4 what? Definitions. Okay. So next, number 10, I want us to look on something called the foreign companies. Foreign companies, in other terms, these are known as companies incorporated outside Kenya. Incorporated outside what? Kenya. So we'll talk about the companies incorporated outside Kenya. These are those particular companies which are registered or basically incorporated in any other country other than Kenya. And this company have started operating in what? In Kenya, have started operating in Kenya. For example, a company registered in Uganda, but that company has started operating in Kenya. Now, that company, we refer to it as a foreign company. Now, the requirement of the Companies Act is that for that company to start operating in Kenya legally, it has to be registered with the Registrar of Companies as a foreign company. So that company will be required to make an application with the Registrar of Companies for it to be registered in Kenya as a foreign company. Once the registrar receives that application, he will go ahead and basically register that company, provided the, that application for registration meets all the requirements of the Companies Act. And that company, once registered with the Registrar of Companies, it will be issued with a certificate of registration, meaning that it has been registered in Kenya or it has been registered by the Registrar of Companies as a foreign what? As a foreign company. As a foreign what? A company. Yes. So that's basically the other type of company. And then we also have something called the corporation aggregate. I'll define this together with something called the corporation sole. So these are basically not per se types of companies, but these are types of legal entities or legal persons. So when we talk about the corporation aggregate, this refers to those associations which comprises of 2 or more persons. And mostly now the private companies, that is the public companies, or those companies which comprises of 2 or more persons, they are good examples of corporation aggregate. Associations which are comprises of 2 or more persons, which have been registered and also recognized as legal entities, separate and also distinct from their members. Corporation sole basically these are the legal offices, which are actually deemed to have the same status with companies. They are those one-man offices, which are basically established by the various provisions of the law. For example, the office of the president, the office of the attorney general, the office of maybe deputy president. Those are one-man offices which are established under the various provisions of the law and actually recognized to be legal entities, which are basically separate and distinct from the Yahoo, from their members, from the members. So those are basically the various types of companies, which basically you need to be aware of. I think maybe some of the questions which I've seen here, maybe like I think last also did something to do with the piecemeal or the stage acquisition, where we said that this whereby the parent company has acquired the control or acquires control in the subsidiary through several purchase of shares. Equally, we did a question as far as that is concerned. In our previous class, we looked on how to prepare the group account, whereby we have a disposal of interest. And actually, we say disposal of interest is whereby the parent company has sold some of the shares, or basically all the shares which are held in a subsidiary. So I think we did a question on partial disposal, but because of time, we are going to do another question on that, but not now. During our revision, we're going to do a question on full disposal, because in terms of how you prepare the group accounts, whereby you have a full disposal, I hope you can be able to recall the financial statements of the subsidiary are prepared in what? In Rwandan francs. So in this case, we are going to look on how do we translate, how do we do the translation. But even before we do that, we look on that, maybe there are some two terms we need to define here. One is something called a presentation currency, the presentation currency, and also something called the functional currency, the functional currency. So when we talk about the presentation currency, this is basically the currency which is used by the parent company in preparing the group account. The currency used by the parent company, currency used by the parent company, to prepare the group accounts, to prepare the group account. In most of the cases, if the parent company is a Kenyan company, this one will be preparing the group account in Kenyan shillings. If the parent company is a Kenyan company, it will be preparing the group accounts using the Kenyan shillings. But that currency used by the parent company to prepare the group accounts is called the presentation currency. On the other hand, when we talk about the functional currency, this is basically the currency, the currency of the primary economic environment, in which a company operates, in which a company operates, in which a company operates. So basically that local currency of the country operates. So if the parent company is operating in Kenya, the functional currency is Kenyan shillings. If the subsidiary is operating in Rwanda, the functional currency or the local currency for that country is Rwandan franc. So therefore, in this case, when preparing now the group accounts, we are saying, before you proceed basically to do the consolidation, before you proceed to add assets, liabilities, revenue, and expenses, those of the parent company, this particular foreign subsidiary, it is important for the financial statements of the foreign subsidiary to be translated into the presentation currency. Into the presentation currency. Remember, you say the presentation currency is that particular currency which will be used by the parent company in preparing the group account. If the parent company is operating in Kenya, it will prepare the group account using what? Or we combine similar items of asset, liabilities, revenue, and expenses. Those of the parent company, those of the foreign subsidiary, asset, liabilities, revenue, and expenses of this company, that is the foreign subsidiary, must be translated into Kenyan shillings, which is the presentation currency. So how do we do the translation? These are the translation rules. These are the translation rules. And this basically what is very, very important you need to remember. Number one, when translating the items of incomes and expenses, and remember in this case what we are translating are the incomes and expenses of this foreign subsidiary. So we translate them, they are translated, items of incomes and expenses are translated using something called the average exchange rate. The average exchange rate. Because in both of these particular questions for foreign subsidiary, you'll be given usually 3 exchange rates. You'll be given the exchange rate at the start of the year, the exchange rate at the end of the year, and also will be given the average. So in this case, we translate incomes and expenses of this foreign subsidiary using what? Using the average exchange rate. Number 2, when translating the assets and liabilities of the foreign subsidiary into a presentation currency, These ones are translated. These ones are translated using the crossing exchange rate. The crossing exchange rate. This is actually the exchange rate at the end of the year. The exchange rate at the end of what? Of the year. So if you're able basically to know that, then this particular question, or the question for preparation of goods, in other terms, we refer to this as the currency translation difference. Translation difference. Currency translation difference is basically an exchange difference which arises from translating the items of asset, liabilities, revenue, and expenses of this foreign subsidiary into presentation currency, of which in this case we are going to see this currency translation difference or this exchange difference can either be a gain or basically a loss. Can either be a gain or a loss. Now, this particular gain or loss, we can say this arises due to translation. This arises due to translation of basically three items. One of it is goodwill. Is goodwill on acquisition. Number two is a profit for the year. Profit for the year. And number three, the subsidiary company opening net assets. So opening net assets. Opening net what? Assets. So we are saying that this currency translation difference, which arises as a result of translating the items of asset, liabilities, revenue, and expenses into presentation currency, it basically arises from the translation of those three items. So I want us to look on how we determine this currency translation difference, which basically arises from translation of those three items. The goodwill, profit for the year, and the opening net asset of the subsidiary. So let's start with the goodwill. So remember, goodwill, this is the difference between the purchase consideration paid by the parent company and the net asset which were acquired. So basically, what is important, first of all, to note here is that when computing the goodwill, first of all, we compute the goodwill, or basically we say that goodwill is computed using the functional currency. Using the functional, remember, is the local currency. For example, the local currency of Kenya is Kenyan shillings. The local currency of Rwanda is Rwanda franc. So first of all, we compute the goodwill using the goodwill is computed using the functional or the local currency of the foreign subsidiary of the foreign subsidiary. So if the foreign subsidiary is operating in Rwanda, what you do when computing the goodwill, first of all, compute the goodwill in Rwandan franc. You compute the goodwill in Rwandan franc, not in Kenyan shillings. Compute that using Rwandan franc, and then translate it, into presentation currency. Translate that into presentation what? Currency. So compute that goodwill using the functional or the local currency of the foreign subsidiary, then translate that into presentation currency. In the process of doing that, we have an exchange difference. How do we compute that exchange difference? I want us to look on how we compute the exchange difference arising from the translation of goodwill. So basically, for us to be able to look on how we determine this, we need to have like a number of columns here. So here we have, in this case, I will assume our parent company operating in Kenya, but the foreign subsidiary operating what? In Rwanda. So here we will have now the local currency of the foreign subsidiary, assuming it is Rwandan franc. This is basically the local currency of the foreign subsidiary. We have a column here for the rate of exchange. The rate of exchange. You'll be given the exchange rate between Kenyan shillings and the Rwandan franc. So here we have a column for the exchange rate. And then here we translate that into presentation currency, which is the Kenyan what? Shilling. So here we always start with the goodwill on acquisition, the goodwill at the date of acquisition. You'll be able to see in all these particular questions for foreign subsidiary, this particular foreign subsidiary is always acquired at the start of the current year. So therefore, what we do, we compute this goodwill on the date of acquisition, which is always at the start of the current year. And I've said we compute this goodwill always using the fractional or the local currency of the foreign subsidiary. So if the subsidiary is operating in Rwanda, we will compute that goodwill using the Rwandan franc, this one. Then we translate that into Kenyan shillings using which exchange rate? The opening, or for opening, the opening exchange rate at the start of the year. We get the value there. And then out to this, what we do is that we less any impairment loss. This particular goodwill automatically will have impaired. So we less impairment loss here. And because this impairment loss is an expense, you have to remember what you have said here. Any item of income or any item of expense will be translated using which rate? Which rate? The average, A for average. Maybe you can just note that somewhere, A for average. And then we get now the impairment loss in what? In Kenyan shillings. So then we take this minus that, and basically you read one line here. That now will give us the value for goodwill at the end of the year. This will be the value of goodwill at the end of the year, and that is the date we are doing our consolidation. Remember, doc is the date of consolidation. So this will be the value for the goodwill at the date of consolidation, which will be at the end of the year. Then we take this particular goodwill, we translate it now into presentation currency. And in this case here, because it's an item of assets, and we are translating that at the end of the year, now we have to use which exchange rate? We use the closing exchange rate. We take this, we translate it into presentation currency using the closing exchange rate. We get the value there. Then for us to be able now to compute this exchange difference, what we do is that we compare the value which we will have gotten here, this one with this one. So we compare these two values here. We compare these two values, this and this, of which in this case we can have an increase. Maybe from this to this, we can have an increase. Or basically from this to this, we can have what? A decrease. We can have a decrease. So that increase or decrease is what we refer to as exchange difference. And this exchange difference can either be an exchange gain or an exchange what? Loss. So if basically we have an increase, maybe from here we have 80 million, but here we have 100 million, you can see we have an increase. An increase is a gain. The value for goodwill increased is a gain. An increase is a gain. But if we have a decrease like 80 million to 60 million, that is a decrease. A decrease is basically what? An exchange loss. An exchange loss. An exchange loss. Now, this particular exchange gain or loss, this one will be recognized in the consolidated income statement. In the consolidated income statement as part of other comprehensive incomes. Will be recognized in the consolidated income statement as part of other comprehensive incomes, So we know other comprehensive incomes, we add this to the gross profit. Not to the gross profit, sorry. We add this to the profit for the year. To the profit for what? For the year. So that's basically how we compute the exchange difference or the currency translation difference, which arises from the translation of what? Of goodwill. Translation of a goodwill. So then from there, once we look on how we compute the exchange difference arising from translation of this. So the exchange difference arising from the translation of these two items, profit for the year of the subsidiary, opening net asset of the subsidiary. This one is computed. We compute the exchange difference together here for those two items. The exchange difference on translation of those two items. So here we need to have the same columns, the local currency of the foreign subsidiary, the exchange rate, and the presentation currency. So always here we start with the opening net asset. The opening net asset. These, in other terms, are the net asset of the subsidiary on the date it was acquired. Remember, we have said in all these questions for foreign subsidiary will have been acquired at the start of the year. So take the opening net asset on the date of acquisition in in local currency, for example, rand and franc. Translate that into Kenyan shillings using the opening exchange rate. You get the value there. And then to this, you add the profit for the year, year. And remember, this is the profit for the year for the subsidiary. In case there is some adjustment affecting or which should be effected in the income statement of the subsidiary, like a depreciation, other charge, maybe something like amortization, which was not accounted for by the foreign subsidiary as a result of fair value adjustment. Remember, whenever the subsidiary has been acquired, the subsidiary can revalue assets, like maybe item of PPE or even things like intangible assets, like maybe brand or something like that. So if the foreign subsidiary revalued some assets, automatically it's never accounted for that. So if it is an item of PPE, you have to compute the depreciation other charge. You are adjusted to this profit. If maybe it revalued an intangible asset like brand, compute the amortization adjusted to this. So you have the adjusted profit for the year. And because these are profit, you translate it into this into presentation currency using which exchange rate? Using the average exchange rate. Using the average exchange rate. The average exchange what? The average exchange rate. And then basically what we do down here, you leave two lines there. What we will have here is the crossing net assets. The crossing net asset of the subsidiary. We translate that now into presentation currency using the crossing exchange rate. Using the crossing exchange rate, we get now the translated value there. And then we take this plus this, and basically we compare these two. We compare this with that, just like what we have done down here. So the difference which you get here is what is known as the exchange difference, or actually this one would be the exchange gain, or the exchange what? Loss. So if from this to this, remember this net assets. So just like goodwill. So if from this to this we have an increase, is an exchange gain. If we have a decrease, is an exchange what? Is an exchange loss. Is an exchange loss. And equally now this one will be recognized within the consolidated statement of profit or loss, or the consolidated income statement as part of other comprehensive what? Other comprehensive incomes. Will be recognized there as part of the other comprehensive incomes. So basically this is how we compute the exchange difference. That is the exchange gain or loss arising from the translation of the various items of assets, liabilities, revenue, and expenses of the foreign subsidiary, of the foreign what? Subsidiary. So once you come across this particular question for foreign subsidiary, usually maybe in Roman 1 of the question, the examiner will require to compute this. The exchange difference or the currency translation difference arising from the translation of goodwill and also the profit for the year and the opening net asset. That's basically how you do that computation. Roman 2, then you'll be Roman 2, Roman 3, crossing exchange rate. So if you can be able to recall that, basically this one is crossing exchange rate. So if you can be able to recall that, basically this one is quite simple, quite simple. And I think with that particular knowledge, I want us to go straight to a question. We go straight to a question on a foreign subsidiary. To a question on a foreign subsidiary. On foreign subsidiary. Usually, this is one of the areas which is very simple. You'll be able to do that. You'll be able to see that. Very simple. Yes. I want us to do a question with both the in and the statement of financial position. And basically the question I want us to start with. Yes, so let's start with this one. April 2022. April 2022. which is the question number 1. Question number one. April 2022. So if you're there, you can just confirm. Yes, are you there? Are you there? Okay. So what are we told here? What are we told? What are we told here? We're told that P Limited is a public limited company listed in the securities exchange. It has diversified its activities by acquiring S Limited, a company domiciled in a foreign country. Both companies prepare their financial statements in accordance with international financial reporting standards. The presentation currency of the group is Kenyan shillings, while S Limited functional currency is franc. Remember, I've explained what is the meaning of those two currencies. Presentation currency is the currency used by the parent company to prepare the group accounts. We are told is Kenyan shillings. But now, this foreign subsidiary, which is S Limited, it operates, we are told, is domiciled in a foreign country. Its functional currency, the local currency of that foreign country is franc, which is denoted by FR. And then you're told the draft financial statement for the year, which ended 31st of December 2021, and set out below. So we're given the statement of profit or loss for the parent and that for S. You can see the statement of profit or loss for the parent company is in Kenyan shillings, but that of the foreign subsidiary is in franc. That's why I say, if, for example, now you're preparing the consolidated statement of financial position, there is no way you can do direct consolidation. That is direct consolidation. You take the revenue and expenses of the parent, you add with that of the subsidiary. You can't do that because you can see those that statement of profit or loss of the parent, that of the subsidiary are in different currency. That's why we are saying even before you do the translation, we translate those items of the foreign subsidiary into presentation currency, which is Kenyan shillings. So then from there we have the statement of financial position for the two companies, P and S. Equally, you can see the statement of financial position of the parent is in Kenyan shillings. That of the foreign subsidiary is in franc. We have non-current asset, current asset, equity, non-current liabilities, and current liabilities. We have additional information number 1 all the way to note number 5. What are we required to do here? We are required to determine the exchange difference, which is basically the gain or loss arising from the retranslation, or basically arising from the translation of the net assets and the goodwill on acquisition of the foreign subsidiary. Part B, we are required to prepare the consolidated statement of profit or loss and other comprehensive income for the year which ended 31st of December 2021. And then from there, we are required to prepare the consolidated statement of financial position. So before we even do that, I want us, we come up with a group structure. Let's come up with a group structure. A group structure. And the group structure. So where do we have information about the group structure? We have that information in note number 1. Let's go to note number 1. In note number 1, you're told on 1st of January 2021, the company which is called P Limited acquired 80% of S Limited, 1 million, 1 franc ordinary shares for a cash consideration of 35.50 million franc. So this company acquired 𝐻 Limited, and basically this 𝐻 Limited, remember, we are told is domiciled in a foreign country. Is domiciled in a foreign country. Is domiciled in a foreign country. In other terms, is a foreign subsidiary. In other terms, is a foreign. Yes. So in this case, we have the parent company and basically the foreign subsidiary. As per that note, we are told the acquisition took place on 1st of January 2021. So that is the date of acquisition. Remember, I said in all these particular questions for foreign subsidiary, usually the subsidiary is acquired exactly at the start. So it was acquired on 1st January 2021. That is the date of acquisition. When are we required to prepare the group account? The date of consolidation doc. So in the requirement, specifically in Roman Part B and Part C, we're required to prepare the group account for the year which ended 31st of December 2021. You can see our subsidiary was acquired exactly at the start of the year. Sasa, yes, we say it's always important for you to note the date of acquisition. So we have that information there. That is the group structure. P is the parent, S is a foreign subsidiary. Now, in that case, we are given the purchase consideration which was paid, which was 35.50, and actually this is in franc. Then no working which is required there, but we are going to use that information in computation of goodwill. In Part B, also not Part B, rather note 2, we are told at the acquisition date, the carrying value of 𝐻 Limited net asset was 2,600 million franc, but the fair value was 3,200 million. In other terms, this company revalued the assets. On the date of acquisition, revalued its net asset. We are told the net asset had a fair value of 3,200 million franc, and the carrying amount of this net asset was 2,600 million. So it basically means that in this case, we have an increase in the value of the asset by 600, which automatically is a revaluation what? Gain, is a revaluation gain. So, and then you're told the excess in the fair value of the carrying amount was due to an unrecognized branch with a remaining useful life of 5 years at the date of acquisition. So we are told this revaluation gain is due to a brand. In this case, a brand is basically a form of a trademark. In other terms, a brand, this one, this is a form of an intangible asset. This is a form of an intangible asset. Just like the other question we did, whereby we were told that the subsidiary on the date of acquisition valued, or basically there was a list of customers which was not yet recognized. And we say that list of customers should be recognized as what? As an intangible asset. The same case with this particular brand. So what is the value for the brand? So the unrecognized brand. Unrecognized brand. And basically we are saying that this unrecognized brand, this is a form of an intangible asset. A form of an intangible asset. So the value for this brand will be the difference here. It will be equal to 200 million franc minus 26. This will be 600, or this will be 600 million franc. Remember, this particular asset here was revalued on the date of acquisition. So how are we going to account for this amount here? This amount of 600. So this amount of 600, number one, this one will be recognized as an intangible asset. As an intangible asset within the consolidated statement of financial position is an intangible asset. Number two, this one is a pre-acquisition revaluation reserve. Is a pre-acquisition revaluation what? Reserve. So that's the first thing you need to know. And then in the same point, we are told that this particular brand had a remaining economic useful life for 5 years at the date of acquisition. Remember, I think in most of the questions which you have done, we were told the item which was revalued was an item of PP. What we were doing, we were computing the depreciation at the charge. In this case, do we depreciate intangible assets? No, we amortize. So what we need to do here is basically we compute the amortization, because what we say is that once the subsidiary company has revalued the asset, the subsidiary company do not account for that revaluation. So what we need to do is to compute the amortization for this brand. The amortization, we compute this using the same formula we were using to compute the depreciation at the charge. We take the revaluation gain for the value at which the asset was revalued at. We divide that with the remaining useful life or economic life. And I think we are told the remaining economic or useful life in note number 2 or 5 years. 5 years, we divide that with 5, and then we should multiply that with the proportion of time. The proportion of time is the time we have between these two dates. In this case, we have 1 year. So we are interested with amortization for just 1 year. For just 1 year. So this will give us what? This will give us 120 million. And it is also important for you to note that this 120 million, this is still in franc. This is in foreign subsidiary. This is in foreign what? Subsidiary. So this one, this amortization, number one, this one is basically an expense. It's an expense within the consolidated income statement. And number two, this one will be deducted from this. So this one will be deducted from intangible assets. So the value for intangible asset would be 600 minus this one, which is basically 120. So I think we are done with that. Let's move to the other point. So let's move to the other point. So in point number 3, we are told the non-controlling interest in 𝐻 Limited as at the date of acquisition was fair valued at 1450 million franc using the fair value model or the fair value method. So it basically means that in computation of goodwill, we are going to use the full goodwill method. That's why we are given the NCI at fair value. So, and then number 4, we are told as at 31st of December 2021, that is at the end of the year, it was determined that the goodwill arising on acquisition of S was impaired by 10%. That is the impairment loss. Okay. So number 5, we are given the exchange rate. We are told the foreign exchange rate are relevant. So what you must be in a position to do is to interpret those exchange rates. For example, we are given the exchange rate on how many days? We are given 3 exchange rates. On first, at the start of the year, which is the opening, we are also given the closing exchange rate, and then you are given the average. You're given what? The average. So how do we interpret that? For example, the exchange rate here at the start of the year. So it is given up there, you can see franc to 1 Kenya shilling. Franc to 1 Kenya shillings, and the opening is 5. So this means that the opening exchange rate is 5 franc. 5 franc, this one is equal to 1 Kenya shillings. Sasa, yes, that's basically the interpretation of that. That 5 franc is equal to 1 what? Kenya shillings. Sasa, yes. So that's basically what we have. And I think now having that information, we can just go straight to answering our question. Let's just go direct to answering our question. But I think before we do that, we start, basically we're going to start with Roman 1. I think the first thing we need to do is let's compute the goodwill arising from acquisition. And remember, you have said we compute the goodwill arising from acquisition of this subsidiary using the foreign currency. The foreign currency of 𝐻 Limited is franc. We compute that goodwill using franc, and then we are going to translate it into Kenya shilling. In the process of doing that, we are going to determine the exchange gain or loss as required in Roman 1. So let's do that. And basically that will be part of the workings. And then we will be able to use that goodwill, to compute the exchange difference. So remember, in this case, the method we are going to use is the full goodwill method. The full goodwill method. So at the full goodwill method, here we just need to let's just have one column. We are computing this in franc. In franc, the foreign currency, the franc, and the figures are given in million of shillings. So goodwill using the full goodwill method, or we compute the goodwill using the full goodwill method by, number 1, taking the purchase consideration which was paid by the parent company. To this, we add the NCI at fair value. At fair value. Remember, we are computing this using the foreign currency, the local currency, which is franc. So this purchase consideration, which was paid by the parent company, that one is within note number 1. Note number one, which is given in franc, and that is 35.50. So we also have this one, NCI at fair value, in note number 3. Note number 3. So the NCI in 𝐻 Limited at the date of acquisition was valued at 1450 million franc. So we add these two values. What do we get? What are we going to get here? Is it 6,000? 6,000 franc? What are we going to get there? Purchase consideration paid by the parent, note 1, 3550 plus number 3, 1450. That will give us 5,000. That will give us 5,000. 5,000. So then to this, we proceed and we less the fair value of net assets acquired. So in our case, we know at the date the subsidiary company was acquired, the fair value of its net asset, as per the information we have in note number 2, the fair value of its net asset is already given, this one. It was that 200 million franc. That is still in franc. Now, take into account we are using the full goodwill method. We will take 100% of this. We are using a full goodwill method. We take 100% of that. So the goodwill arising from acquisition, the goodwill arising from acquisition is how much? Goodwill arising from acquisition is how much? Is the goodwill arising from acquisition is 1,800 million. 1,800 million. It's also important for you to note that this is still in, this is in foreign currency. This one is in franc. Now, having that, I think we can just go straight to part A of that question. Part A, and basically we are required to compute the exchange difference. The exchange what? The exchange difference, which is basically a gain or a loss, on translation of two items, net asset and goodwill. So we're going to start by computing the exchange difference on translation of goodwill. On translation of goodwill. Translation of goodwill. Translation of goodwill. Translation of goodwill. So this one is very, very simple. Very, very simple. Provided you can be able to remember the format which I've given you for computing this. If you can be able to remember that format, this one is quite simple. So in this case, we need to have various columns here. The first column here will be for the foreign, the local currency of the foreign subsidiary, which is franc. We have the exchange rate, and then we are translating that to Kenyan shillings. And our figures are in million of shillings. Are in million of shillings like that. So what we start with here, we start with the goodwill on the date of acquisition. The goodwill on the date of acquisition. So the goodwill on the date of acquisition is this one. That is 1,800. 1,800. So we translate this into Kenyan shillings using which exchange rate? Which exchange rate do we use here? Remember, this is the goodwill on the date of acquisition, 1st January 2021. Is that the case? So we translate this using the opening exchange rate. The opening exchange rate as per note number 5 is 5. And basically that is 5 franc, which is equal to 1 Kenyan shillings. So how do we translate this into Kenyan shillings? Remember this is franc. This is 1,800 million franc. We want to translate that into Kenyan shillings like that. So basically we need to cross multiply, then we divide. So we take 18 times 1 into divided by 5. In other terms, what is important for you to note here, when translating, in translating franc into Kenyan shillings, you'll take the figure which is in franc, you divide that with the exchange rate. Like in this case, 1,800 is in franc. To translate that into Kenyan shillings, you divide that with the exchange rate. If you know that now, it becomes much simpler. Yes, because you'll be taking all the figures in franc to divide to translate them into Kenyan shillings. You divide that with the respective exchange rate. So we will divide that with 500. So we take this divided by 5, not 500, sorry, by 5. That will give us what? That will give us what? We try to hurry up. So that one will give us 360. That one will give us 360. And then out of this, we have said we need to less the impairment loss. The impairment loss. So the impairment loss, we are given that information in note number 4. Note 4, we are told as at 31st of December 2021, it was determined that the goodwill on acquisition of S was 10% impaired. So this goodwill was 10% impaired. 10% of this is 180. 180. So first of all, we need, this is an item of expense. Being an item of expense, we will translate that into Kenyan shillings using the average exchange rate. The average exchange rate, as per note number 5, is what? Is 4. Is 4. Is 4. So we take this divided by 4. What do we get? 180 divided by 4. That will give us what? That will give us 45. 45. Then what we do, we take, remember this one should reduce the value for goodwill. Eh? So what you do, you leave 2 lines there. And then we will have the value for goodwill at the end of the year. That is on 31st of December 2021. So this minus that basically that will give us what? 1800 minus 180. That one will give us 1620. So that's the value for goodwill at the end of the year in foreign currency, in functional currency. Sasa? Yes. Now, before we proceed to determine the exchange difference, which is a gain or a loss, first of all, get the difference between these two values. Write that value here. Write that value there. Oh, sorry. So this one should be 6. The average is 6, not 4. The average is 6. Yes, thank you for that. The average is 6, not 4. The average is 6. So this one would be 30. That one would be 30. Is that the case? Yes, 180 divided by 6 is 30. Is 30. The average is 6. Yes. So we get the difference between this, which will give us 330. 330 equally. Ensure you have a line here. Then what we do, we translate this goodwill at the end of the year into Kenyan shillings using the closing exchange rate. The closing exchange rate is what? Is 4. So we take this divided by 4, and that now will give us the value for goodwill at the end of the year in Kenyan shillings divided by 4. That will give us what? 405. Gain or loss arising from translation of goodwill. Arising from translation of goodwill. So then, still in Roman 1, we need to compute the exchange difference, which is gain or loss, which arises on translation of net assets. Translation of net worth, translation of net assets. Translation of net assets. So we need to have the same format here. The local currency or the functional currency and the present assets is what we have here. So we know that at the date the subsidiary was acquired, it revalued its net assets, and the net asset of the foreign subsidiary had a value of what? 32. So that is the opening net asset. The opening net asset of the foreign subsidiary. So we need to translate that into rate. The opening exchange rate is 5. This one. The opening exchange rate. The opening exchange rate. That will give us what? So which will give us what? 6. Are you getting 640? Are you getting 640? Yes, 640. Then to this we have said we add the adjusted profit for the year. The profit for the year of the foreign subsidiary. And basically that one should be the adjusted one. The adjusted one. So let's go to the income statement of S Limited, which is a foreign subsidiary. From the income statement of S, how much was its profit for the year? Its profit for the year is 1,500. Is 1,500. 1,500. I hope you can be able to see that. From the income statement of S, its profit for the year. Is that 1,500? 1,500? Yes. Now, I'll say you need to check whether this foreign subsidiary that is S, whether it had something like depreciation, other charge, depreciation overcharge, maybe something like amortization, which was not yet accounted for. So in our case, what we have is this amortization. Remember, S Limited didn't account for this revaluation of asset. It never accounted for this amount. It equally never accounted for this what? amortization. So if this amortization was accounted for, automatically that one was supposed to be deducted in arriving at this what? Profit. So we deduct that amortization from that profit for the year. That will give us what? That will give us 1380. Is that the case? 1380. 1380. Are you getting 1380? 1380. Divided by 6. Divided by 6. That will give us what? That will give us to 30. So then what we need to do, make sure you leave 2 lines here. And then we have the net asset, the crossing net asset, the crossing net assets. The crossing net asset will be this plus this, which will give us 4580. 4580. And actually, this one should always reconcile. This one should always reconcile with the net asset of the subsidiary at the end of the year. Remember how we compute the net asset of a subsidiary. We said you can either take asset minus liabilities or equity. We said in group accounts, we compute the net asset as the share capital plus reserves. So if we go to the statement of financial position of this company, that is S, what is the value of its net asset, which should be the share capital plus reserves? Can you see that figure? I can see that as a figure of 41. Is that the figure? 41. The share capital plus reserves. Yes, you can see it's not reconciling with this. The reason being that there are a number of items which our company had not accounted for. This company revalued the asset, but never accounted for that. Remember, if S Limited had accounted for this amount of 600, this was supposed to be accounted for as a revaluation reserve. Being a revaluation reserve, it was supposed to be included here. The company was supposed to add 600, and then the profit for this is also part of this. Profit for this is part of this. So the company was supposed to deduct or to have accounted for this as an expense. Was it accounted for? No. So that 120 should be deducted from that value there. And if you work out that, it should give us this value there. It should give us that value. So the reason why those two figures are not reconciling this and this is because our company had not accounted for those two items. If you work out that, is it now reconciling? Is it reconciling? Yes, it is reconciling. Now, what we need to do then, we translate this into presentation currency using the crossing exchange rate. Using the crossing exchange rate, 4580 divided by 4. That will give us 1145. 1145. 1145. So then what we need to do is basically we add these two values, which will give us 870. And then we compare this and this. We compare that with that. We determine do we have an increase or a decrease. I can see we have an increase. An increase is an exchange gain. Is an exchange gain. Is an exchange gain, of which this one will be part of other comprehensive incomes. So which I'm told is 275. 275. Yes, in our case we are done. We are basically done. That is what was required as far as that question says. That is part A of that question is concerned. By doing that, you get 6 marks. I want us then we move to part B of the question, which is very, very simple. Very, very simple. You'll be able to see that. Part B, what are we required to, which is basically for the year, which ended 31st of December 2021. 31st of December 2021. Now, how do we prepare this one? We prepare that by consolidating, by basically combining similar items of revenue and expenses, that of the parent, that of the subsidiary. But we have said before we do that, we have to translate items of revenue and expenses of this foreign subsidiary into Kenya shillings. We have said to translate this, we always use the average exchange rate. The average exchange what? Rate. So let's just do that translation here as we prepare this. So this would be in Kenyan shillings, and our figures are in million of shillings. So we go back to the statement of profit or loss for individual companies, which is given, I think, below paragraph 2 of our question. We take the revenue of the parent, which is 2145, plus the revenue of the subsidiary, which is S, that is 10,500. But because this one is in franc, we need to translate that into Kenyan shillings by dividing that with the average exchange rate. Dividing that with the average what? Exchange rate. So the average exchange rate, as per the information we have in note number 6, is note number 5. The average exchange rate is 6. So do we have any adjustment here? No, because the only adjustment affecting revenue is intragroup trading. Do we have any amount of intragroup trading? No. So we just need to get the final value here. 10,500 divided by 6 plus 2145. I'm getting 38.95. 38.95. So then from there we check the cost of our sales. Cost of our sales, we do the same. We take that of the parent, 915, plus that of the foreign subsidiary, which is 63. We divide that with the average exchange rate, which is 6. Do we have any adjustment here? No, because we know that the only adjustment which is effected here is adjustment for ungauged profit, depreciation under charge, which we don't have. We don't have any of those adjustments. So just an issue of translating 63 divided by 6, 1050 plus 915. So which will give us 1965. So we less that from the revenue, we get the gross profit. We get the gross profit. The gross profit. The gross profit would be how much? The gross profit. The gross profit, I'm getting, yes, I'm getting 13 what? 90. So then from there we have the distribution cost. The distribution cost, in all questions for group account, we said these items do not have any adjustments. Just maybe translating the distribution cost of the subsidiary into what? Into the presentation currency, which is basically 750. I will equally divide that with 6. I will equally divide that with 6. And I hope you can see what we are translating is only this of the foreign subsidiary, not the total. Not the total. 750 divided by 6 plus 150. So that will give us 275. Then from there we have administrative expenses. Now for the administrative expenses, we have that of the parent, which is 345 plus 1350. This one we divided with 6. Now in this case, there are two other items we need to capture here. One, we have what? This company here, we have this amortization. This amortization, remember this amortization was not accounted for. We said amortization, that one should be included as part of administrative. And because it is still in franc, we added to this. We are going to translate all this using the average. All of them are items of expenses. The other item we also need to capture here is this impairment loss. The impairment loss, this one. So let's add it here still in franc. That is 180. Yes, you can see this is in franc, this is in franc, this is in franc. We get the total administrative expense of the subsidiary, and then we divide that with the average. We divide that with the average. Yes. So we take 1350 plus 120 plus 180. We divide that with 6. 275 plus 345. And in that case, I'm getting 620. I'm getting 620. 620. I hope that is what you're getting. Is that what you're getting? 1930 minus 275 minus 620. So I'm getting operating profit of 1035. Can you see how simple this is? Can you see how this simple this is? This one is very, very simple. And actually, this is a question they keep on repeating. And this question, I think, was still tested some time back. They keep on repeating this question here. So this is this kind of the area, which is very, very important, which is very, very simple. That is. So then below that, we have investment income. Investment income, we take that of the parent, which is basically 15, and the subsidiary 0. So nothing need to be translated there. And then we have the finance cost. Finance cost, we take that of the parent plus that of the subsidiary 150, we divide that with 6. No adjustment here. So we take 150 divided by 6, 25 plus that which will give us 55. Yes, so then we get the profit before tax. The profit before tax, which is this. So this investment income, sorry, should be added to be deducted. Plus 15 minus 55. So that will give us 995. And then out to this we less the income tax expense. So the income tax expense also is another an item which do not have any adjustment. Although in this question there is nothing which was to be adjusted except the administrative expenses. So 165 plus 450, we divide that with 6. 450 divided by 6 plus 165, which will give us to what? 240. And then we get the profit for the year. The profit for the year. So this will give us 755. So to this then, finally, I hope you can see there is nothing else which is given in that statement of profit or loss. But here, we must proceed and we add something called the other comprehensive incomes. The other comprehensive income. So what do we recognize here as other comprehensive incomes? So these exchange gains. The exchange gain on translation of goodwill, exchange gain on translation of net assets. So the exchange gain on translation of goodwill, which is 75, and also on translation of net assets, which is 275. And we get what? We get the total comprehensive incomes. We get the total comprehensive incomes. So I'm getting 11 what? I'm getting that 1105. Are you getting that value? Yes. So basically that is it. That was required in part B of that question. And basically these are the items which are marked in that question. So by doing that, the marks allocated there were 6. So let's move to the other part of the question. And that is the statement of that is part C, the consolidated statement of financial position as at 31st of December 2021. 31st of December 2021. Yes. So how do we prepare this one? We prepare this basically by combining, by adding together similar items of assets and liabilities, that of P, that of S. But now, remember the assets and liabilities of the foreign subsidiary are in franc. We translate them into presentation currency using the crossing exchange rate. The crossing exchange rate. That is what is important here. So we will start with the non-current asset, and remember our figures here will be in Kenyan shillings. In Kenyan shillings here. So we start with the non-current assets. The non-current assets. So for the non-current assets, we have the PPE, property, plant, and equipment. So we will take that of the parent, which is 4850, plus that of the S Limited, which is 7,000. And then now we divide this with the crossing exchange rate. The crossing exchange rate as per note number 5 is 4. So no adjustment here because there was no item of PP which was revalued. So we just get the final value. So I'm getting what? I'm getting 66. I'm getting 66. Are you getting 66? Are you getting 66? Yes, 66. So down there, what we have is the investment in S. The investment in S is automatically the purchase consideration which was paid by the parent company in acquiring shares of S. I hope you can be able to remember that amount, which was here, this one. It was 35.50, but now this amount, this one is in franc. Automatically, this one was translated into Kenyan shillings at the date the purchase consideration was paid. The purchase consideration, this one was paid at the start. So this one was translated into Kenyan shillings using the opening exchange rate, which is 5. So if you divide that with 5, that will give you what? 710. So, but do we include that amount here? No, we don't include the purchase consideration paid in acquiring a subsidiary here. What we include instead, we include the goodwill on acquisition of S. And the goodwill on acquisition of S at the end of the year is basically what we have here. This goodwill, which has already been translated in Kenyan shillings. This one, 4.5. That one, Sasa, yes. So the other item which you must also remember to include here, because we don't have any other non-current asset, remember the subsidiary revalued this brand. We can just include it here as unrecognized brand. So the brand was valued at an amount of 600, but it was supposed to be amortized with an amount of how much? 120. So we left 120. But now, remember these figures are in franc. That now will give us the unrecognized brand at the end of the year. So which will be 480. We need to translate that using the closing exchange rate. I hope you can see what I've done. 600 minus the impairment loss. That will give us 480, which will be the value for unrecognized brand at the end of the year. But still in franc, we need to translate that using the closing exchange rate, which now will be 120, because it is 480 divided by 4, 120. So we move, and then we record the non-current asset. Sorry, the current asset, that is. I think we can do away with this one. Yes, so we record the current asset now. The current asset. So for the current asset, we have inventory. We take that of the parent, which is 1030, plus that of S, which is basically 24. We divide this with 4. That will give us 600. That will give us 1630. We have trade receivables. We take 970 plus 1960 divided by 4. Yes. So no adjustment here. You can see we don't have any adjustment. I'm told it's 1460. I'm told that is 1460 by Mercy. I hope that is correct. I hope that is correct. Okay. So then from there we have the cash and cash equivalents. So we do the same. We take 4 for 10 plus 540 divided by 4. No adjustment still. Yes, what are you getting? Yes, 545, like that. 545. Okay. So basically we are done with that. We said in this question, never bother yourself getting totals. What is marked are these. These are the entries which are marked. Never bother yourself getting totals. So then we move and basically we record what? We record equity. So we start with the ordinary share capital. So for the ordinary share capital, basically we know that we only include the share capital of the parent. Which is 15. So below that we have share premium. Share premium will also include that of the parent company only, which is 500. Below that, what do we have? We have the retained earnings. The retained earnings, we say no need of computing. That one is just leave it. Don't bother yourself computing that. But now, in these questions, because we may come across a question maybe in the topic when covering cash flow, you see these particular exchange differences which you have recognized here. When we have those exchange differences, this one. So we compute the exchange difference, which is basically attributable to the parent company, and we recognize it here as a component of equity. Basically, we refer to that as currency translation reserve. Currency translation reserve, the currency translation reserve for the parent company. So to compute the currency translation difference for the parent, we basically get this total. This will give us a total of what? This will give us a total of 75 plus 275. That will give us what? Is it 350? Yes, and then we compute that of the parent company. That of the parent company will be equal to 80%. That one will be equal to 80% for the parent. That's that? Yes. For the parent, that which we include here. That's why you can see even share capital, share premium, we are including that of the parent. 80% of that will be 280. That one should be recognized there as a component of equity. So then in that case, automatically we can't be able to get the total. So equally below here, there is something else we compute. No need of equally computing this one. Then NCI, we just leave it. And then now from there, we proceed to record the liabilities. We record the liabilities. We start with the non-current liabilities. So for the non-current liabilities, we have 10% bonds. 10% bonds. I will take that of the parent, which is 820 plus 2640. But this one, remember, we translate items of asset and liabilities using the crossing. Items of asset and liabilities. The crossing is 4. The crossing is 4. That will give us what? 660 plus the 820. Yes, that will give us 14. That one will give us 1480. 1480. So then from there we have the deferred tax. The deferred tax. So the deferred tax will do the same, 740 plus 2160, divides that with 4, and then we get the final value here. What would be the final value? The final value. Is that what you're getting? Yes. So then next we have the current liabilities. The current liabilities. So for the current liabilities, we will start with the trade payables. We will start with the trade payables. So for the trade payables, we will take 1330 plus 2240. We divide that with 4, and then current tax. Current tax, we take 520 plus 760, divided that with 4. Divided that with 4. So that's basically how we get the final values there. So 1890, I presume that is payables. What about the current tax? What about the current tax? The current tax is what? Is 710. Is 7 what? 10. 710, 710, 710. So basically that would be the total equity and what? And liabilities. Total equity and liabilities. So no need of getting the total because there are 2 items you have not computed up there. And that question, if you do it like that, even if you have not computed the NCI, even if you have not computed the group retained earnings, basically that is the question will be able to score all the marks. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. 14, 15. So 15 out of how many months? Out of 8. So automatically take into account we have 8 months before this, how such a question is marked. For any 8 at 1, you just need to get 8 items correct. If you just get 8 items correct, you have all the 8 months. You have all the 8 months, all the 8 months. And I think that should also apply here. Any 6 at 1, any 6 correct item, you get 1 mark each. By the end of the day, you get your what? Your 6 months. Your 6 months. So that is it. That's basically how we do the translation and also the consolidation. Can you see how simple this is? Yes, this is very, very simple. This is a question I think which has been repeated for a number of times. This question was examined some time back, but they decided to repeat it in this particular sitting here. There is a question I want to give as an assignment. I think the question for which sitting? December 2023. You attempt this question December 2023, which is basically question number 1. You'll be able to see it's just the same. Although this question there was an adjustment affecting I think payables, but just attempt it. Maybe during our revision, we will be able to see whether we will get some time and look on that question. Sasa, but that is it about regarding the foreign or the overseas subsidiary. It basically means that once now we meet next week, we are basically finalizing on this. We are finalizing on this because now what is remaining is on group cash flow, or basically the consolidated cash flow. That is what is remaining. But automatically we will be able to come back to this topic during our revision, because remember I said that this is a very serious area. If you check on the past papers, you'll be able to see mostly there are 2 questions which come from this topic. 2 questions. A question for group cash flow, and another question for group account. Like the paper which was there last meeting, how many questions were there? I think last meeting there was just 1 question. There was just 1 question, which was very simple. Actually, that paper for last meeting, it was one of the easiest paper which has ever been tested. There was 1 question, but if you check on the other paper for, I think, December 2024, there were 2 questions. There was a question for group accounts, I think piecemeal acquisition, and there was a question on cash flow. There was a question on group cash flow. If you check on the paper for August 2024, there were still 2 questions, group cash flow and another question. So that's why I'm saying that this is a very, very common area in the exam. Either you get 2 questions of 20 marks, or basically maybe 1 question. But mostly, I expect 2 questions this sitting, because you can see last time there was no question on cash. So compute that goodwill using the functional or the local currency of the foreign subsidiary, then translate that into presentation currency. In the process of doing that, we have an exchange difference. How do we compute that exchange difference? I want us to look on how we compute the exchange difference arising from the translation of goodwill, So basically, for us to be able to look on how we determine this, we need to have like a number of columns here. So here we have, in this case, I will assume our parent company operates in Kenya, but the foreign subsidiary operates in what? In Rwanda. So here we will have now the local currency of assuming it is Rwandan franc. This is basically the local currency of the foreign subsidiary. We have a column here for the rate of exchange. The rate of exchange, you'll be given the exchange rate between Kenyan shillings and the Rwandan franc. So here we have a column for the exchange rate, and then here we translate that into presentation currency, which is the Kenyan what? Shilling. So here, we always start with the goodwill on acquisition, the goodwill at the date of acquisition. You'll be able to see in all these particular questions for foreign subsidiary, this particular foreign subsidiary is always acquired at the start of the current year. So therefore, what we do, we compute this goodwill on the date of acquisition, which is always at the start of the current year. And I've said we compute this goodwill always using the fractional or the local currency of the foreign subsidiary. So if the subsidiary is operating in Rwanda, we will compute that goodwill using the Rwandan franc, this one. Then we translate that into Kenyan shillings using which exchange rate? The opening, O for opening, the opening exchange rate, the exchange rate at the start of the year. We get the value there. And then out to this, what we do is that we less any impairment loss. This particular goodwill automatically will have impaired. So we less impairment loss here. And because this impairment loss is an expense, you have to remember what you have said here. Any item of income or any item of expense will be translated using which rate? Which rate? The average, A for average. Maybe you can just note that somewhere, A for average. And then we get now the impairment loss in what? In Kenyan shillings. So then we take this minus that. And basically, you read one line here. That now will give us the value for goodwill at the end of the year. This will be the value of goodwill at the end of the year. And that is the date we are doing our consolidation. Remember, DOC is the date of consolidation. So this will be the value for the goodwill at the date of consolidation, which will be at the end of the year. Then we take this particular goodwill, we translate it now into presentation currency. And in this case here, because it's an item of assets, and we are translating that at the end of the year, now we have to use which exchange rate? We use the closing exchange rate. We take this, we translate it into presentation currency using the closing exchange rate. We get the value there. Then for us to be able now to compute this exchange difference, what we do is that we compare the value which we will have gotten here, this one with this one. So we compare these two values here. We compare these two values, this and this, of which in this case we can have an increase. Maybe from this to this, we can have an increase. Or basically from this to this, we can have what? A decrease. We can have a decrease. So that increase or decrease is what we refer as exchange difference. And this exchange difference can either be an exchange gain or an exchange what? Loss. So if basically we have an increase, maybe from here we have 80 million, but here we have 100 million, you can see we have an increase. An increase is a gain. The value for goodwill increased is a gain. An increase is a gain. But if we have a decrease, like 80 million to 60 million, that is a decrease. A decrease is basically what? An exchange loss. An exchange loss. An exchange loss. Now, this particular exchange gain or loss, or the currency translation difference, which arises from the translation of what? Of goodwill. Translation of a goodwill. So then from there, once we look on how we compute the exchange difference arising from translation of these two items. So the exchange difference arising from the translation of these two items, profit for the year of the subsidiary. So the exchange difference arising from the translation of these two items, profit for the year of the subsidiary, opening net asset of the subsidiary. This one is computed. We compute the exchange difference to be, in other terms, at the net asset of the subsidiary on the date it was acquired. Remember, we have said in all these questions for foreign subsidiary will have been acquired at the start of the year. So take the opening net asset. The opening net asset on the date of acquisition in in local currency, for example, Rwandan franc. Translate that into Kenyan shillings using the opening exchange rate. You get the value there, and then to this you add the profit for the year. The profit for the year. And remember, this is the profit for the year for the subsidiary. In case there is some adjustment affecting or which should be effected in the income statement of the subsidiary, like a depreciation, other charge, maybe something like amortization, which was not accounted for by the foreign subsidiary as a result of fair value adjustment. Remember, we said whenever the subsidiary has been acquired, the subsidiary can revalue assets, like maybe item of PP or even things like intangible assets, like maybe brand or something like that. So if the foreign subsidiary revalued some asset, automatically it's never accounted for that. So if it is an item of PP, you have to compute the depreciation at the charge. You are adjusted to this profit. If maybe it revalued an intangible asset like brand, compute the amortization adjusted to this. So you have the adjusted profit for the year. And because these are profit, you translate it into this into presentation currency using which exchange rate? Using the average exchange rate. Using the average exchange rate. The average exchange what? The average exchange rate. And then basically what we do down here, you leave two lines there. What we will have here is the crossing net assets. The crossing net asset of the subsidiary. We translate that now into presentation currency using the crossing exchange rate. Using the crossing exchange rate, we get now the translated value there. And then we take this plus this, and basically we compare these two. We compare this with that, just like what we have done down here. So the difference which you get here is what is known as the exchange difference, or actually this one would be the exchange gain, or the exchange what? Loss. So if from this to this, remember this net assets. So just like goodwill. So if from this to this we have an increase, is an exchange gain. If we have a decrease, is an exchange what? Is an exchange loss. Is an exchange loss. And equally now this one will be recognized within the consolidated statement of profit or loss, or the consolidated income statement as part of other comprehensive what? Other comprehensive incomes will be recognized there as part of the other comprehensive incomes. So basically this is how we compute the exchange difference. That is the exchange gain or loss arising from the translation of the various items of asset, liabilities, revenue, and expenses of the foreign subsidiary, of the foreign what? Subsidiary. So once you come across this particular question for foreign subsidiary, usually maybe in Roman 1 of the question, the examiner will require to compute this. The exchange difference or the currency translation difference arising from the translation of goodwill and also the profit for the year and the opening net asset. That's basically how you do that computation. Roman 2, then you'll be Roman 2, Roman 3, you'll be required to prepare consolidated income statement, consolidated statement of financial position. I've said for you to prepare number 1, the consolidated income statement. So before you even, or basically when combining the revenue and expenses of the parent and that of the subsidiary, you'll take that of the parent, which is already in presentation currency, but you have to translate that of the subsidiary. We have said that all these items of the subsidiary will be translated using the average. All items of the income statement will be translated using the average exchange rate. But the items of asset and liabilities, those of the foreign subsidiary, will be translated using the crossing exchange rate. Crossing exchange rate. So if you can be able to recall that, basically this one is quite simple. Quite simple. And I think with that particular knowledge, I want us to go straight to a question. We go straight to a question on a foreign subsidiary. On foreign subsidiary. Usually, this is one of the areas which is very simple. You'll be able to do that. You'll be able to see that. One of the areas which is very simple. Very simple. Yes. I want us to do a question with both the income statement and the statement of financial position. And basically the question I want us to start with. Yes, so let's start with this one. April 2022, which is the question number 1. April 2022. So if you're there, you can just confirm. Yes, are you there? Are you there? Okay, okay. So what are we told here? What are we told? What are we told here? We're told that P Limited is a public limited company listed in the securities exchange. Listed in the securities exchange. It has diversified its activities by acquiring S Limited, a company domiciled in a foreign country. Both companies prepare their financial statements in accordance with international financial reporting standards. The presentation currency of the group is Kenyan shillings, while S Limited functional currency is franc. Remember, I've explained what is the meaning of those two currencies. Presentation currency is the currency used by the parent company to prepare the group accounts. We are told is Kenyan shillings. But now, this foreign subsidiary, which is S Limited, it operates, we are told, is domiciled in a foreign country. Its functional currency, the local currency of that foreign country is franc, which is denoted by FR. And then you're told the draft financial statement for the year, which ended 31st of December 2021, and set out below. So we're given the statement of profit or loss for the parent and that for S. You can see the statement of profit or loss for the parent company is in Kenyan shillings, but that of the foreign subsidiary is in franc. That's why I say, if, for example, now you're preparing the consolidated statement of financial position, there is no way you can do direct translation. Sorry, direct consolidation. That is direct consolidation. You take the revenue and expenses of the parent, you add with that of the subsidiary. You can't do that because you can see those that statement of profit or loss of the parent, that of the subsidiary are in different currency. That's why we are saying even before you do the translation, we translate those items of the foreign subsidiary into presentation currency, which is Kenyan shillings. So then from there, we have the statement of financial position for the two companies, P and S. Equally, you can see the statement of financial position of the parent is in Kenyan shillings, that of the foreign subsidiary is in franc. We have non-current asset, current asset, equity, non-current liabilities, and current liabilities. We have additional information number 1 all the way to note number 5. What are we required to do here? We are required to determine the exchange difference, which is basically the gain or loss arising from the retranslation, or basically arising from the translation of the net assets and the goodwill on acquisition of the foreign subsidiary. Part B, we are required to prepare the consolidated statement of profit or loss and other comprehensive income for the year which ended 31st of December 2021. And then from there, we are required to prepare the consolidated statement of financial position. So before we even do that, I want us, we come up with a group structure. Let's come up with a group structure. Group structure. And the group structure. So where do we have information about the group structure? In note number 1. Let's go to note number 1. In note number 1, you're told on 1st of January 2021, the company which is called P Limited acquired 80% of S Limited, 1 million, 1 franc ordinary shares for a cash consideration of 35.50 million franc. So this company acquired S Limited, and basically this S Limited, remember, we are told is domiciled in a foreign country. Is domiciled in a foreign country. Is domiciled in a foreign country. In other terms, is a foreign bank. Then no working which is required there, but we are going to use that information in computation of goodwill. In part B, also not, we are told at the acquisition date, the carrying value of S Limited net asset was 20, but the fair value was 3,200 million. In date of acquisition, the value of its net asset. We are told the net asset had a fair value of 3,200 million.